All right. Good morning, everyone. I'm very excited that we are able to do this another round of class before the end of the year. So this class this time around is different from every other class that we've done in the past. In the past, we've always done every day in the evening, 6 to 9, 7 to 10, as the case may be. But by popular demand this time around, almost everybody voted for weekend classes. And I had to put this timetable together to enable us to complete this class as soon as possible. And as you can see on my screen, let me see if there's a way I can blow this up a little bit more so you can have a better view. Good. I think the view is better now, right?
Yes, it is.
Uh-huh. So you can see, I just want to have a quick kickoff meeting, then we go right into it. We'll be having classes every Saturdays and Sundays, morning and evening. Okay. Saturday morning will be 5 to 8, and then evening will be 7 to 10. Same as Sunday, 5 to 8, and then 7 to 10 in the evening every weekend. This plan seems aggressive. Yes, I agree with you guys. But the objective is for us to maybe Saturday, Sunday, I know is when we sleep in, rest a little bit in the morning. But if we can make this sacrifice for the next 4 weeks or 5 weeks, as the case may be, I think it's going to be worth it at the end of the day. And here's the plan I have. We're going to start with life insurance because, from my experience, everything still comes down to life insurance. And
Okay.
if you have the grasp of life insurance, it branches out from there to from there to ethics, from there to accident and sickness. Now, the goal for this class is not to go line by line in the text. The goal of this class is for me to explain the principles, for you guys to get the understanding of the principles. And for that, I'm going to go through the text and then identify those key principles, break it down for you guys. And then we are going to devote more time to solving questions and answers, because that gives us an overview of areas that we may not have even touched during the reading of the text or the analysis of the text. That makes sense. Now we will be what other things again? I will be recording the classes, and I will be putting it in the Telegram group after the fact for those that missed the class to go back and play catch up from there. Now, is that a license not to attend the class? I don't think you will be doing yourself any good, because being in the class is another energy for you. You participate because the question and answers is going to be participated by all the attendees, right? And then you
Yeah.
be involved in the analysis, analyzing the questions, and then you get to understand it better. Okay. And then last but not the least, for the kickoff segment of this class, and those that have just joined us, I want to say welcome to Xperio. I want to say big welcome to Bola. You are such an amazing soul. Thank you.
Thank you,
And
thank
I'm
you, thank you,
super
thank you, thank you,
happy
thank
to be in this business to you. And I also want to welcome Kojo and her husband. You guys are awesome. You're welcome to this business. And I want to tell you that this is a good business. And so long as you follow the guidelines and everything we are willing to share with you, you'll be fine. And then, Chamaka, you're amazing. You started your studies, but this class I know is going to help you a great deal. And for those of you I didn't mention your names, that does not mean I did I forgot about
you.
you or did not want to acknowledge, but because of time, we have to keep this moving. Now, as you are taking these classes, I don't want you to pack your books Sunday evening and revisit it the next Saturday morning. No, everything, once we are done Sunday evening, go back in the course of the week, review it, make sure that you are locked solid, at least in the areas we've covered for that weekend, before the next weekend. That way, the last weekend, for example, this life insurance, you see that on this date, we will be doing certification in the class here. So if you are not constantly building yourself, on the 12th, when we'll be doing life insurance certification, you will not be ready. I don't want anybody to find themselves. Let's follow this. You see, it takes commitment on my part too. But if I can be committed to this, let all of us be committed to this so that we finish strong, we get what we wanted, and we move on to the next phase in this business. So on that note, I want to say welcome to the November licensing class. Thank you very much. All right. So moving on to the real deal now. I want to open this from my machine because when I open this on the drive, it's not opening the way I want it. So let's go there. Hllqp and life insurance. There we go. Awesome. So this, I need to blow this up. Yeah. I love this size now. And where's my zoom? Okay. All right. So the study materials we're using, like I must have mentioned to you guys, is Oliver. And the reason I love Oliver is because their textbook is kind of summarized in a way that I like it. Okay. So we're using Oliver material. And like I said, we're going to go through it today. This class is from chapter 1 to chapter 3. So fasten your seatbelt. I'm so excited. You see, and every time I take classes like this, it brings back home, this knowledge again, this fresh awareness, So I enjoy doing this. And guys, when it comes to the questions and answers, our goal is not to answer all the questions, right? But the understanding and the breaking down of principles. So if we get some of the answers wrong, don't come and say, Teacher Joy, I thought you know it all. No, that's not the thing. That's not the thing.
A gentle disclaimer.
Yes. So a quick run through the table of content for this morning. We will be going through the introduction to life insurance module. You see, when you are done with this module, even your village members, they cannot tell you otherwise the importance of life insurance. Okay. So under that topic, we'll be touching on the risk of death, the potential financial impact of death, the risk of management challenges. All that we'll cover in chapter 1. And then we will move on to, you see, when I'm taking classes, this is how I'm writing. We'll do life insurance. Then under that, we have what? Risk of death. Then, secondly, potential
Financial impact of
financial impact of death. I hope you guys have notes to be jotting down something. Then the point number 3 under that is the risk management strategies. What are the risk management strategies that we can implement to curb all these issues that we have seen in point 1 and 2? So we look at the risk management strategies. You see, when I see stuff like this, I think even people that have license should once in a while drop in on us in this class, because when you are doing this thing, you read to pass exams, right? But when you sit down, you are not studying for exams and you are going through this again, it kind of sharpens your memory on how you even talk to people more about this service that we provide. Then we move on to chapter 2, which is term life insurance. I've come across lots of people that have insurance. They don't even know what they have. It means the advisors didn't even tell them. You understand? And then there are other MGAs out there that they sell just one product. So when they come, you know, their name starts with G. You understand? When they come, they only promote only that one that they have. So they won't even be telling people about term insurance. So in this one, we'll talk about what is term insurance. Then the typical term insurance, age limit, right? And then policyholder versus lives in life. You see, these are parties to life insurance, okay? So we have policyholder versus life/lives insured. These are two different, technologies and individuals and parties to the concept of life insurance. Then we have single life, joint first to die. Oh, this one, they love testing it in exam a lot. Okay. We also have joint last to die.
That's a very interesting thing. Which one is first to die?
Yes. Joint first to die, joint last to die. And then the way they test it, they'll tell you, okay, which circumstances would either of these be more beneficial? So don't worry, we're going to break it all down.
Get there. Okay.
Yes. So we talk about death benefit. Then we'll talk about this one I'm even writing. 1 second. I have this printed out. Maybe I should get out my printer. I guess I will look for where I kept that printout later so we don't waste much time. Sorry about that. Okay.
Okay.
So death benefit we talked about. Then level, we have level death benefit. Then we have decreasing term. Then we have increasing term. Then we will also be looking at term insurance premiums.
Term insurance premiums.
Yeah. Then we also be looking at how are the premiums set, right? How premiums are set. So that is based on mortality cost and also life insurance expenses. Then we move on to renewable and non-renewable term insurance. Then under that, we will be looking at, the renewable provisions, renewable with guarantee rate, re-entry term, okay, and then convertible term and all that. So all these are things that we will be looking into under the term insurance contract, okay? Then finally, we will look at advantages and disadvantages of term insurance and what needs can term insurance fulfill, okay? Because term insurance is not for everybody. So for people that it is suitable for, what solutions would that help them with? And that takes us to chapter 3, where we'll be dealing on whole life insurance. So I'm considering that we didn't start on time and then because of the kickoff, wherever and everything. So I'm looking for us to maybe cover all the text, maybe in about 2 hours or so, and then we leave 1 hour for the question and answer. Okay, so chapter 3 is all about permanent life insurance. And for this one, we'll be looking at whole life and versus term 100. Okay, the concept of permanent insurance, will look into that. The coverage term, will look into that. The policy reserve, will look into that. Then how premiums are set for whole life, we'll also look into that. We'll look at mortality costs, the expenses involved in whole life, the investment, the returns on the investment of whole life. We will be looking into that as well. And the premium options, the ongoing premiums, the single premiums, limited payments and death benefit options, guarantee whole life and adjustable whole life. All that, will break it all down. Okay. And that takes us to participating and non-participating whole life. All right. How shortfalls or surplus occurs and non-participating policies or non-participating policies. Okay. Then we also look at participating policies as well. We identify the difference between them. Then we look at dividend payment options for participating policy. All right. Then we'll move on to cash options, the premium reduction options, accumulation options. All these are the dividend payment options for participating whole life, investment options, and then what happens on these options upon death, and then paid up additions. Okay. Then we come back again to term insurance, because we're going to see because what's going to happen here is that we look at term insurance, whole life, participating whole life, non-participating whole life, and then the term insurance. Okay. Now, this term insurance here right now is not term insurance standalone like we had before. It's where you are taking your payment option to buy term insurance. Okay. So we'll look into that and how that is different from the standalone term insurance that we must have seen at the beginning. The impact of death benefits and cash values. Okay, then we look at dividend illustrations. Now, non-forfeiture benefits, we'll talk about that. All right, so this, you can see that this chapter 3 is heavily loaded. Is loaded. So I'm just praying, oh God, help me. I don't know how we're going to do this with time, but I really want us to keep to time. So yeah, without much further ado, so those are the areas we'll be covering this morning. And then once we are done with the text, we jump on to the Q&A. Okay, so let's do this. I'm just scrolling through this now so we can get to, I think I'm going to drag this thing down because I think I moved it too fast. Okay, I think, okay, risk of death. So yeah, here we are, one. You see, death is a risk everyone is exposed to. It's just like when we drive on the road, right? The moment you carry your car keys and you enter your car and you're driving out of your house, you are exposed to known and unknown risk. Okay, the one you know, you protect yourself against it, but the one you don't know, you have no control over, right? And that's why in this country, even before you drive, the government insists that we all carry an auto insurance before we even drive, right? So the same thing when it comes to life, we are exposed to life as similar as that too. So the probability that an individual will die at a specific age is called mortality rate. Okay? So there's mortality rate, there's a table to calculate this, there are data to calculate this, and that's why in Canada today, we have the data to back this up that the average lifespan of women is 84 and that of men is 82. There are many factors that influence the risk of an individual dying. Okay, this is age, okay, and then the person's gender. You see, men do not live as long as women. All right, and when we start, yes, when you start writing quotes, you see that men's quotes are usually more expensive. Even boys are paying more than girls, you see. right? And then personal and family health as well, history, all these they contribute to. And then habit. You see, some people smoke, and then some people, do some risky stuff that impact their lifespan. Then the kind of job, some jobs, you see, jobs and income level, high income earners enjoy their lives and live longest. And then there are some jobs that expose people to risk and environmental factors as well. Life insurance company, in assessing the risk of death when a person applies for life insurance, they collect all these factors, okay?
Okay.
And then this is the profile. They use it to profile this individual to now determine, okay, this person is a male and then is in this age bracket and this, and that is how they come up with the pricing. And now this does not happen like okay, they collect it, they go and no. Now all these things are built in, they are coded into the software that we use to run
Okay.
illustration. And that's why when you put the person's age and then a gender, we are able to get the idea of how much that person will be paying. Okay.
Mm-hmm.
So that is what happened there. And the risk of death is based on life expectancy. And this is the average number of years a person within a certain group and of a certain age can expect to live. Okay, that is crystal clear so far. I'm going to fly through some of these ones that are not that deep, that are not a deep concept. Okay, but feel free to, to stop me or call me back if you feel I'm flying too much. Okay, now it takes into account the past mortality experience. So how do they get about all this mortality rate, which is a combination of all these things we just mentioned? Is because they have all this data, all these statistics, and they put into consideration and the past experience. When we say the past experience, we are talking about the past death history, the past claims that they have experienced. All those contributes to come and cumulatively comes together to give the insurance company all this information to arrive at this mortality rate. Okay. In Canada, at birth, males have life expectancy of 79.8 years and female 84.2 years. Okay. Probability of death. And this is the livelihood of a person within a certain group and of a certain age dying in a year, expressed as a percentage. Okay, what is the probability of that? And this, it assumes that the past mortality experience of the group to which that person belongs will hold true in the future. At age 30, a male has a little over 1% chance of death that year. That probability of death increases with age. At age 85, a male has have more than 8% chance of dying that year. So you see the way they group this band, right? So
Mm-hmm.
at age 30, there's age 40, depends on the group band that the insurance company may have, behind the scene that they are using to drive this number, and which is, expected because they are in the business to insure people and pay a huge sum of money when these people dies or when they fall sick, depends on whatever insurance they have taken. So they have all this data too. And this help insurance companies to plan too, because every year they have a projection of the number of people they expect to die. And then based on that, they set aside that money to fulfill those claims, right? And how are they able
Mm-hmm.
to do that? Is because of all this information that they have in their database.
Data.
Okay. So there is a table here, that breaks it down, in a year one, the 10th year, and then you will see here for male, female, and then stuff like that. So I'm not going
Mm-hmm.
to start explaining the table. These are things that when you are doing your personal reading, you can go through it one by one. Okay.
Mm-hmm.
So all these statistics are here for us to lean on. Okay. Now let's run down to financial impact. Okay. Potential financial impact of death. Now, these are the things that we need to make people aware all the time. The consequences of death when we access the client's needs. All right. We need to explore the risk with the client because people's financial risk differs. Somebody that have 5 children, like me now, I have 5 children, and then we have other financial liabilities and obligations. That is the way my own risk of death will be assessed, right? Now, if somebody have just 1 or 2 children and maybe they don't have as much, they don't own a house, or they own a house is a condo or is an apartment, their financial risk of death might be lower. So those are the things we need to look at, okay? And the death benefit helps families manage the financial consequences resulting from the death of an immediate family member. That's absolutely true. Okay. Chapter 10 takes deeper look at this. So we are going to see this again in chapter 10. But here are the following examples of financial impact upon somebody's dying. Number one, if a young father who is the primary income earner dies, then the death benefit will be available to look after the children and their homes, right? Now, debt repayment, if they are owing, for example, almost a lot of people, I don't, I just want, almost everybody in this country have one house, two houses, and stuff like that, where we carry mortgages. That is debt, right? So imagine somebody have those mortgages and the person passes away, right? The liabilities does not pass away simply because the person passes away.
Right.
Yeah. So making plans for all those things is very important because the debt benefit can be used to pay off those debt or those financial obligations. Now, creditors may demand immediate repayment of the loan. In some cases, may be willing to extend the loan to surviving spouses. For example, if the person that passes away is the sole owner of that investment or the house, right? The creditors may start demanding, oh no, we want our money right off the bat. They may have even had a payment arrangement with the person that died, but now the person has passed away, they just want their money. But in some cases, they might be willing to extend it to the surviving spouse. But what if the surviving spouse doesn't have a strong credit history to hold,
Okay.
yes, to qualify in the first
Apply for
place?
the loan.
See that? So it's
That's
not that it's going
interesting.
to be automatic. There's going to be a qualifying, process that go into. What if the surviving spouse doesn't qualify? Perhaps because the man is the one that works, that brings the bulk
Yes.
of the money. See? So these are the things. And then there are income taxes too. Upon death, an individual is deemed to have disposed all of his property at fair market value. You see, this one, how when you tell people this one, they may even think that
Hmm.
maybe you just want to sell them something. But whereas it's not the case. This government, the CRA feels you have sold your stock prior to the person dying at fair market price, unless rollover, unless rollover or tax exemption provisions apply. You see, taxes are expressed, assessed, and any capital gain must be paid. And the executor may have to sell assets of the estate. What is this talking? What is it saying in essence is that when husband and wife holds a property jointly together,
Okay,
and then one
system,
of
okay,
the
system. I
spouses
don't want them
passes
to
away,
come down.
that is okay. CRA is a very patient dog. So those assets will roll over to the spouse. Okay? However, when those assets roll over to the next generation, it will trigger taxes. Now, And this rollover, there are so many factors that comes into play. There are so many things, and that is why I always tell people, get your paperwork done, do your will, identify what you have, know what goes where, know the tax implication of wherever you are putting your assets. We're working so hard to get these things, then we should bring out time, even though it's one day, to get our wills done. But how can we say this enough? We have a lot of work to do. See, estate creation, education fund, providing funds for university, college, or education, establishing legacy, and providing financial gift to some special upon death, and charitable givings are common estate objectives. Now, what is the business of donating through or doing all these things through an estate? Okay, the business impact is that the death of the business partner may force the sale of the business. As well, significant revenue could be lost due to the death of the key employee. The revenue loss could be so severe that it puts into question the continuity of the business. For example, Justin and Tanya are both 30 years old and they have 3 children, aged 1, 3, and 4 years old. Tanya currently stays at home with the children, so Justin is the sole income earner. How will this young family cope financially if Justin died? The loss of Justin's income will be devastating. Now, consider what will happen if Tanya was the one who died. As the sole income earner, Justin will not be able to afford. Sorry, let me back that. Now, what will happen if Tanya was the one who died? As the sole income earner, Justin will not. Why is this thing jumping on me? Where is Justin now? I was. Okay, Justin will not be able to afford to stop working to care for the children. Okay? Okay, to care for the children unless another person could step in and assume the role of the caregiver to the children free of charge, such as one of Justin's or Tanya's parents. Justin will have to hire someone to assume this role. Now, if Justin dies, the bank is unlikely to extend the mortgage to Tanya because she is not working. That was what I mentioned earlier, right? She will have to sell the family home to pay off the debt. You see, death benefit proceeds from life insurance can be used to help minimize financial impact of death on the surviving family. It can provide the money to pay for a substitute for caregiver. It can help repay debt that might otherwise have to be taken from the value of the estate of the deceased, right? Now, the death benefit proceeds will also help to pay the tax liabilities owing on the estate. The death benefit will also help to create an estate that includes money to be used towards the future education cost of the deceased children, to also create a legacy that is by paying inheritance and giving towards charity. These death benefits proceeds can also be used to protect business assets by funding a partnership agreement. You see that?
Yep.
So these are all the benefits that, or all the solutions, all the gaps that death benefits payout can help bridge. Okay. Now there is a new concept here that has just been mentioned, and that is partnership agreement. Okay. For example, Allen owned a thriving boutique restaurant called Vertical. Some of its success was due to its amazing location, quirky interior decorating, and personable staff. But the real draw was Vertical's chef, which is Ligue, or whatever. Anyways, okay. Now, customers raved over Ligue's signature dishes and his tableside manner. He always visited each table personally to say hello and to make sure each meal was to the customer's satisfaction. You see, so in this case, number one, Ligi was not the owner of the business, but he's a chef, an outstanding chef as that, right? Now, when Ligi died suddenly, the restaurant revenue dropped dramatically. It took Allen almost 6 months to find a chef of the same caliber. Then Allen had to launch an expensive marketing campaign to lure customers back to the restaurant. The financial strain during this time came very close to bankrupting Allen. So did we understand the dynamics of what is happening here? So on the top here, we have um, Allen, who is the owner of this restaurant, right? Now, Ligi is not the owner of the restaurant, but an employee that have proven himself good at what he does, right? And when he died, that impacts Allen's business significantly. Now, how can we manage the risk, or what risk management strategy can we use in this kind of situation? Let's see. Risk management is the choice or choices a person makes in regards to the risk he or she faces. Different risks can be managed differently, right? So remember, you see how this is going, right? Remember when we started with the risk that as human, we are exposed to the risk of dying, right? And then we move on to analyze, okay, what is the groups? What is the mortality rate? How is the life expectancy, or what contributes to one's dying? We talked about age, we talked about gender, we talked about family history, we talked about well-being, that is income, like, right? Like people that was and earn good incomes, they tend to take good care of them. We talked about nature of jobs, right? Now, all these things. Then we talked about the risk and the needs, the solutions that life insurance death benefits can also provide. Now we are now looking at what risk management strategy can we put in place to curb, you see, when we are exposed. For example, when you're driving, see, one of the risk management strategies we implement immediately we sit in our car is what? I need contribution. What risk management strategy do we put in place when we are driving as soon as we enter our car? Bola, are you there? Hello, Bola. Okay, we need to keep it moving. Maybe we need to keep it moving. See, one of the risk management strategies we put in place is by fastening our seatbelt. We put on our seatbelt, right? That is risk management strategy. Now, winter is upon us. Now, what do we do at this time? We change our tires to winter tires if you are not using all seasons tires, right? So these are risk. So what are the risk management strategies? This is an exam typical question, so don't sleep on this one, okay? Number one, there are 4 ways to manage risk. Number one is risk avoidance. Okay. Number two is risk reduction. Number 3 is risk retention. And the number 4 is risk transfer. You get it? Okay, so we're going to go into this and explain it now. Number 1, which is risk avoidance. In this strategy, an individual will avoid the situation or circumstances that exposes them to the risk. For example, not smoking, right? Now, so these are, by not smoking, you have avoided the risk that are associated with what? With smoking, right? Let me take a sip of coffee, guys. Okay. The second risk management strategy is what? Risk reduction. So this is a strategy that is used, okay, when risk cannot be entirely, cannot be entirely avoided. Okay. Now, the way I blow up this thing when I move, okay, risk reduction. Okay, risks are exposed to wearing. Okay, so yeah, so this risk reduction, for example, this is the risk we are exposed to. We are exposed to by wearing seatbelt reduces your risk of personal injury in case you involved in an accident. So that is risk reduction. So you cannot avoid it. Okay, the first one is risk avoidance. So you can avoid completely by not smoking. But again, risk reduction, you can't avoid it, but you can reduce it. You see, by putting on your seatbelt, changing your winter tires, make sure your car is in good shape, right? That's your risk reduction. Then risk retention, this one, you can't do anything about it. In this strategy, the individual accepts some or all the risk. A person without life insurance retains all the financial risk of permanent death, right? So if you choose not to have life insurance, that is okay. So it means you are retaining your risk. You are retaining. So it means that if your mortgage is, you are owing 500K on your life, you have 2 children, you, wherever, right? So it means that you are retaining that risk. But my brothers and sisters, if you have chosen to retain your risk, you better have the associated ability to solve it when the need comes on. Does that make sense? So that is risk retention. Then the fourth one is risk transfer. You see, this is the one that you say, oh, you know what? I don't have $1 million, because if you are owing, maybe your mortgage, you bought your house, 800K, thousand, and then you paid 300,000 so far, and you are owing 500, and then you have 5 children, and then you have elderly parents you're taking care of, and you have car loan. All this, by just doing a quick dime in my head, this person instantly needs $1 million of coverage, right? Because calculate 500,000 for house, 5 children, 50,000, that's 750. Maybe there is elderly parents, or even apart from even elderly parents, how about maybe car loan and some other stuff, right? Credit card debt, maybe student loan. So that's like almost $1 million, right? So, and you say, I don't have $1 million, so, but I can transfer this risk to somebody who has bigger muscle than myself. And this person is what? The insurance company. And this is what this whole thing is all about. We are transferring our risk to the big brother. And in exchange, the big brother say, okay, you see, because I'm a big brother, I can carry this 1 million for you. But in exchange, you be paying me small. As you don't have ability now, you'll be paying me small of what we call premium. This is it, right? So let's read this in risk transfer. When some or all of the risk is transferred, that is moved from one to another, See, life insurance transfer financial risk from the individual to the insurance in exchange for premium payment. And the example is here. I'm not going to read this example again because I have talked about the example of big brother and small brother. Okay, so we've seen the four. That is exam questions: risk avoidance, risk reduction, risk retention, and risk transfer. Okay, Bola, are you back now?
I am. On the four
Risk
ways to manage
management
risk.
strategies.
Avoidance is not to even get into it at all. I see the example, not even
Yes.
starting smoking, avoiding bad behavior, I reckon.
Mm-hmm.
Reduction, wearing seatbelt, okay, reducing the possibility.
Yes.
Risk retention, I don't get what that is. If you could just,
Okay, so risk retention is like you choose to keep the risk. You
okay.
know that you have, let's say, you have financial obligation of $1 million, right?
Mhm,
You are owing bank on your mortgage 500,000. Maybe you have student loan, you study medicine, you have student loan of 200 and something thousand, and you have like 5 children, right? And you
mhm.
choose not to get life insurance. So if you choose to keep your risk, always have a backup plan for that risk in the case it crystallizes,
What
right?
would the backup plan be? Example is what?
I have $1 million. Have what it takes.
Okay.
Have what it
So
takes to
so
solve that
basically
problem.
stupidity. Okay. I
Yes.
see.
So that is it. You understand? It comes back
Yeah.
to, yeah, you see. So it's going to be what it is for you, right? And we have work to do. And that's why this
Yeah.
business, once we can be educating people like this, and I tell our team members, don't go around saying, oh, I sell insurance. No, give people value. Do you
Yeah.
understand? Imagine when you
I
sit
have
down with
something
people.
for you. Exactly.
Yes. Oh, and some people, they even tell you, oh, I already have life insurance. I say, okay, I understand. But can I help you take a look and perhaps give you my independent opinion? Because some people may have gotten life insurance when they came to this country. Maybe at that time they own a condo or they were
Mm-hmm.
renting. But now they own a house.
Their
Maybe then
profile
they
has
didn't have
changed.
children. Now they have
Mm-hmm.
children.
Mm-hmm.
So their risk there is increased, but
Mm-hmm.
they've not increased their risk management strategy to match the increase of their
Mm.
risk. See that, right? And on that, we have concluded chapter
One down, 100 to go.
1. So that brings us to the end of chapter 1. And you can see that this thing it's not complicated. It's fun, isn't it?
Is that chapter 3? This one is still bread. This one is still, this
Okay, should
one is
we jump
still,
to chapter 3 then?
no, no, no. This one is still appetizer. Chapter 3,
That's
you have,
appetizing. They're using this one to warm us up,
yeah,
which makes sense,
exactly.
right? And then we
Yeah.
now start getting into the meat. But
I
don't
think
worry, I
from
got you
what I
guys.
see
So
from
that's
chapter 1, the most, I reckon that these 4 ways to manage risk could be a major in the exams, I'm thinking.
oh yes, oh yes. That is
Okay.
I said it earlier, is a
Yeah.
guaranteed exam question. You see. Now let's move on to chapter 2, where we talk about term life insurance. Okay. Statistics Canada life expectancy and other elements of the life table Canada in all provinces except Prince Edward Island. So these are just statistics and informations wherever. Okay. Now, what is term? You see, when the word term is from the word temporary. Okay, when you hear term,
Okay.
just know that it's a limited time frame. Okay,
Okay.
when something is term, it means it's ripped off a permanent nature. Okay, so now a life
Mhm.
insurance policy is a contract. The two words contract and policy means the same thing. okay, and are used interchangeably. So you see contract or policy that means the same thing. Then term life insurance is a contract that promises to pay death benefit upon the death of the life insurance over a set period of time to a specific age. So I raise my tone when I use the word set because that is that word time right there. Okay. So
Okay.
the set period of time, it could be 5 years, it could be 10 years, it could be 20 years, but we can
So
only have it till age
term life
65.
insurance is like after the person dies, the payment will be for XYZ time. That's the term. That's the term
Mm-mm.
part of it.
So now if you take term insurance, let's say I take term insurance now for 10 years, okay?
Mm-hmm.
This is 2023, November 4th. So it means that
Mm-hmm.
this policy will expire 2033, November 3rd, exactly 10 years from today.
So that
So
the
if I
person has to die within this period of time. Ah, wow.
you have to die, if you fail to die,
God, I
no,
beg you.
no. You see, because we are recording this, I don't want to
I know,
send negative energy on
I know.
term
So
insurance.
the
But
term
the
is
thing
not
is that,
period, is to the life of the individual that is signing the contract. So that the space of time that you're covered for. So after that time,
yes,
you have to renew it. Okay, okay, I see.
yeah, you can renew it, but the thing is that we're going to see. Okay,
Okay.
yeah, you're right. You are in this thing, so we're going to see. You see the need, why term, how is term useful in the course of this. Okay, so term insurance is
Yes.
not bad on its own, but
Yes.
is there for specific solution. And
Okay.
that's why we need to evaluate our clients to be sure that this is what they need before we
Best
sell
for
it to
them.
them.
Okay.
Mhm. You see, term insurance typically used to cover and protect during a person insured by the oh no, to protect specific needs. For instance, a 25-year-old mortgage could cover with a 25-year term policy. You see, that is
Okay.
one of the
Okay.
ways we can use term insurance. And for some people, they may say, okay, my mortgage amortization is 25 years, okay? My
Okay.
kids are young now, so I can take term insurance for 25 years. In the next 25 years, my mortgage is fully paid. My kids have graduated. I don't have my risk, financial
You're
obligations
reduced.
low, right?
Yeah. Yeah.
So at that point, I may not need life insurance again. So that is
Right.
another way to go about it, right? Now,
Okay.
if the person insured by the policy dies during the term, the contract, the death benefits, the life insurance coverage is paid to the beneficiary. If the person does not die during the term, the insurance policy expired and there is no
Okay.
refund of
Okay. I understand now. I get it.
it. Uh-huh.
So it's not necessarily negative. It has its function and its
It has its
benefits.
function. No, it's not. No, it's not all negative. No. Okay.
Okay.
Now, term insurance can be issued for 1 year, for 5 years, even up to 30 years, depending on the age of the policyholder. Okay. Now,
Mm-hmm.
the longer terms have higher premiums because the risk of death increases at that. Now, like term insurance is the cheapest form of life insurance. For example, when somebody is younger, they are taking term insurance for maybe 10 years or 20 years. My God, it's so cheap, right?
Mm-hmm.
But the thing is that the longer you take, because the longer, if you have term insurance for 30 years, for example, and that person currently is 30, so it means they are going to be covering this person till age
Until the
60.
60.
They're already counting their risk, and that makes the
Mm-hmm.
premium to be higher. Now we have age limit when it comes to term insurance, okay? There are specific age limit, but the maximum age one can get term insurance is coverage is till age 75. Again, it depends on the insurance company. Some ends it at 70, some 65, but we still have few that provide coverage till age 75. The older the age at which the policy ends, the higher the premium because the risk of death increases in steps with increasing age. That kind of makes sense, right? Most insurance companies will not issue insurance policy past specific age, which I just mentioned, 75 or 80. I don't even know of any insurance that's covered to 80, except if these are legacy policies, okay, due to high risk of death. All right.
Yes.
So moving on to policy holder versus life and life insured. So these are terms, these are terminologies. Okay. These are terminologies that is not a complete. The policy holder is the individual who owns the life insurance contract. That person is the policy holder. And this is the person that is responsible for making decisions on all the insurance contracts. Okay. Some decisions such as the who is the beneficiaries and then and when can the policy be taken out, these are made by the policy holder, the policy owner. Okay. The life insured is the person upon whose or on whose life the insurance contract was taken. Okay. More specifically, the individual who, upon his or her death, a death benefit will be paid out to the policy's beneficiaries. And now, the policyholder may be the same person as life insurance. Now, let me break this down because they are just
Yeah,
saying so
please
many
do.
things here and it can get confusing. So we have policyholder here, we have life insured, then we have beneficiaries. Okay. Now, policy holder is the person that owns the policy. Is a person that took the policy that comes to me and say, let's say, Bola, you come to me now and say, hey, Joy, I would like to take a policy on myself, right? Oh, no, let me not even say, you, okay. Let's say you say, oh, I want to take policy for my mom. Are you with me?
Okay.
Now, you, in this case, you are the policy holder.
My
Your
mom is the
mom is
life
the life
insured.
insured.
Okay, got it.
Now, you, the policy holder, you are the one that have the power, the authority to make decision regarding that policy. Number one, you are the one that pays the premium. Number two, you are the one that has the ability and the power and authority to name the beneficiary.
Okay.
And number three, you are the one that decide, okay, yes, I want to take, you are the one that decide when and choose to take the policy on your mom. Okay, you may take policy for your mom and then choose maybe somebody else as beneficiary. That right belongs to you.
Her grandkids, yeah.
Now, the policyholder may be the same as the person as the life insured, but how that works is that, let's say you come to me again and say, hey, Joy, you know what? I would like to take a life insurance policy on myself. So in that case, now you are both the policyholder and the life insured. Make sense?
Got it.
So, okay, so that's what they are taking your turn. The policyholder may also be called the insured. That is not that this is different from the life insured. Okay, so that is that. Now, the life insured in a contract is usually one person. Okay, upon the death of this person, the death benefit is paid. It triggers death benefit payment. Okay, to the beneficiary. So again, they are giving all those examples here. Now, let's move on to the different kinds of insurance policies. So we have single life, okay? Most term insurance policies are single life. What is single life? The meaning of single life is just one person it insures just one life. All right? So if I take a term insurance on myself down for 20 years, that is single life policy, meaning that only one person is insured and the death benefit will only be paid if that person dies within the term of the contract. Make sense?
Okay, we've gotten to first to die. Okay, let's go.
Don't worry, we're going to break it down. Okay. So we've talked about the parties to life insurance, talked about policyholder, life insured, and then beneficiaries. And then we also look at single life policies. Now we are looking at joint first to die. Now, this is the exam question. Joint first to die, joint last to die. Those are exam questions. A joint policy is an exempted to a single life form of contract, such that this policy insures two or more people. Okay. A joint contract usually names two people as the life insured. Now, when the contract is written as joint first to die, the death benefit is paid out upon the death of the first parties. Okay. And then the policy terminates. How does this work? Let's say husband and wife came to join and say, okay, we want to take term insurance, okay? But because we don't know who is going to die first, and we don't want to start taking single policy on husband and single policy
Another one
on
on
wife,
wife.
because our major goal is our mortgage. Because whoever dies first, we want to be able to, the remaining spouse, to be able to pay off the mortgage, have money to take care of kids' education, and take care of stuff. Okay? So in that case, we do joint first to die. So these couples, both of them will be insured. Whoever dies first will trigger the payment of the death benefit, and that life insurance policy will terminate.
I see.
You see that, right? Maybe the man that will die first, it may be the woman that will die first. Whoever goes first. That's
Okay,
it.
so
And that
whoever goes first, the other spouse and the kids become beneficiary of the policy.
depends on who they name beneficiary.
Okay.
Depends on
Okay.
who they names beneficiary. If they are here with mortgage and they go and name their family members in the village, that's up to them. Okay. So the joint
Got it.
first to die contract, naming the surviving spouses as beneficiary. So usually it's the surviving spouse that will be named as beneficiaries. You understand? But even after we preach this, some people self, you wonder within they follow them.
We're breaking the chains. We're doing it.
Yes, you see. So yeah, so that is that. Then some insurance companies may offer the survivor the opportunity to continue same level of coverage on his or her own life after the date. You know, some insurance companies does that, some don't, some you just it will end, right? Some will give the surviving spouse option if he wants to continue to cover her own life, and then they will restructure it for her. Okay. Now, that is joint first to die for you. Then why pick joint first to die? What is the use of joint first to die contract, right? The contract usually has lower premium than having two separate single life contracts. Okay. Joint first to die life insurance is also used to fund business buy and sell agreement, as discussed. We'll see that in chapter 8. Also, a combined insurance is making concept. Insurance is a marketing concept and is different from joint life insurance. You see, this one is good in a situation whereby, and I explained this again a lot to, some women have difficulty getting their, it may not be just women, it may be some, let me use the term spouses, right? If you have a spouse that does not believe in life insurance, nothing you will say that will pass through the ear, then you may want to go through this option. At least there is no that will help to reduce the tension of, oh,
Elevate the
you want
fear.
to kill
You
me
now
and take
kill
the
me.
money. So that is a soft landing place to start from. Okay. Now, with a combined life policy, two separate policies are purchased. So this one is a combined insurance. You see, it's a marketing concept and it's different from joint life insurance. So this one, I did this one from one of my clients with Manulife, right? In this case, to their benefit, this is combined. This is not joint. You see, this is um combined policies, and the benefit is a reduced administrative fees and a small discount on the premium. Okay.
Okay.
Mhm.
So this is
Um,
still is this still the joint first to die, or is this a separate
no, this
concept?
is joint term combined. So this one
Okay.
now, husband and wife have combined term insurance. They may take it 20 years, right?
Okay.
So
Okay.
when one person dies, the company pays, but the other one still have her own policy running. Do you
Oh,
understand?
okay. Okay.
So when
Okay.
the second person dies, the company still pays.
Okay.
So the advantage of this is that they enjoy discount and they enjoy reduced admin fee, which inversely reduce their premiums. Okay.
Okay.
And there's an example here we can read on our own later because we have a big monster waiting for us in chapter 3.
Hmm.
Now, I'm not saying that to discourage you guys, especially those that will be watching the video. So just relax. Now move on
Let
to
me get
joint.
this. The first one you explained to us was joint first to die. We got that.
Yes,
Then the next one was combined termed.
joint combined terms.
Okay. Joint
And then this
combined
one
termed.
now, this third one is joint last to die. So this is similar to joint first to die, but in this case now, this is like opposite of joint first to die.
Okay.
So
Okay.
this one now, the death of the first spouse does not trigger payment.
Okay.
So when the first spouses, the one of the spouse, the first one dies, no benefit will be paid. Okay. The contract is written as last to die, and the death benefit is paid when the last person dies. Thus, both parties will die for the payment to be triggered.
This one
Okay.
sounds like what a husband would do. Until we go together, you want to shop what money? You lie.
So, but the thing is that this kind of policy is not for everybody. Okay. If you
It's
have
like
a young
rich
family
people.
and you
Yeah.
have mortgage and you have children that are school
Yes.
age
Yes.
children and
Yeah.
you have student loan, car loan, all those things, join first to die is not the right solution.
Yeah. Yeah.
Because when one first person dies, money will not be paid. So how would
Mm-hmm.
no, this is not for everybody, okay? For
Mm-hmm.
example, this is used for estate planning purpose.
It
Okay.
looks like
Yes, this
it's
is
for
for
people that
estate
have
people that have
coins.
finished shopping life. This one will say,
Yeah.
okay, this one, when we go, we don't want
The
CRA to
final.
come after our children. Use
Yeah.
this money to
Yeah.
settle CRA. This is just
Yeah.
for that purpose, right? Say, for
Yeah.
example,
Makes
Edwards
sense.
and Helen have joint last to die contract, naming their son as the beneficiary. If Edward dies, Helen receives no death benefit. If Helen
Mm-hmm.
dies, Edward receives no benefit. After Edward and Helen dies, then their beneficiary receives the death
Yeah.
benefit.
For the
Sum of
beneficiaries. Makes
contract
sense.
is useful for estate planning, including creating an inheritance for the beneficiary and paying estate costs, such as income tax, particularly when the risk being insured against does not arise until the death of the last person covered by
Mm-hmm.
the policy. Remember that I mentioned at the beginning that TRA is a very patient dog. You see, when
Mm-hmm.
husband and wife jointly owns estate, when the first person dies, CRA doesn't come after you. It flows automatically to the surviving spouse. But
Mm-hmm.
as soon as the last spouse passes away, salary
They're
comes
coming
after
for you.
that estate. There will be
Mm-hmm.
taxes deemed to be paid. So that is the situation this is good for. Okay. And then there are some parents that wants to set something up for their grandchildren.
Kids, yeah.
And then even for charity donations and all that stuff. Now, look at here, because during last to die policies pays the death benefit upon the death of the last survivor, whose time of death could extend beyond the length of the term policy. These policies are more commonly used with permanent insurance. See that? And there is an example here to go over. Okay, so we'll move on to death benefits. See, all life insurance policies, not just them, pays a tax-free death benefit. And when the life insured dies, it is paid to the beneficiaries. Okay.
Oh, so money paid in death benefits is tax-free.
Oh yeah, 100% tax-free. That's why
Interesting.
we're
Never
telling
knew
our,
that.
why won't you do something like this?
Just makes
The
sense.
money, imagine if you take for 1 million, that 1 million is paid tax-free.
See the
Oh
prayers
yeah.
of the beneficiaries. They'll be fasting
Mm-hmm.
and praying for the.
See, however, term insurance may provide a decreasing death benefit called a decreasing term policy. An increasing death benefit called, okay, so this one now, there's some concepts we are looking at now. These are term death benefits, right? Now, the way the death benefits are paid, right? It could be level, it could be decreasing, it could be increasing. It depends on what you choose, okay? And I've seen this in several policies I've reviewed. Some people don't even know that their death benefit is leveled. Some don't know it's decreasing, okay? So what do we mean when we say a death benefit is leveled? When a death benefit is leveled, a level term policy has a set death benefit. In other words, if you take policy for 500,000, for example, and it's leveled, so it means that upon the passing away of the life insured, that 500,000 is what will be paid, nothing more, nothing less. So that is a level term policy, okay? And this is the most commonly used one. So why will you pick a level term contract? Is because life insurance needs are not expected to change over the term of the disease. So when you pick a level, so it means that you have assessed your risk and you've established that they are not going to increase over the term of the contract, okay? And then the policy is easy to understand, it's not complicated, and it's also the cheapest form of life insurance. Note that many people who purchase term life insurance often do not take into consideration what their needs might that their needs might change over the policy, over the term of the policy. Okay.
So other than leveled, what other type is there?
So decreasing, which is the next one, there's decreasing and there's increasing.
Okay.
So we have level, we have decreasing, then we have increasing. So decreasing is the one we are going to look at now, but feel free to look at this, read all these examples when you have some time. Okay. So now a decreasing term policy has a death benefit that becomes smaller and smaller as time passes by. Okay. Now, why is it decreasing? And also, now the premiums is also on a decreasing term policy are lower than the premium on the level term policy of the same amount. Insurance company typically offers decreasing term insurance on a group basis. So why would you want to pick a decreasing debt benefit? So what this means is that, let's say you pick a decreasing term policy, right? May start your debt benefit may start at 500,000, right? Then 5 years later, it may come down to what? 450. Now, this is good for people that whose goal is to cover their mortgage primarily, because as you are paying your mortgage, your debt balance is on a reducing trajectory, right? So you can mimic that to the level of reduction of your mortgage to use this. And the whole idea is so that you pay less premium. Okay.
So as the possible benefit is decreasing, so is the payment as well.
No, your premium is not reducing because that reduction in premium was factored into the premium set for you at the beginning. And that
Okay.
is why when you put it side by side, what a 500,000 level benefit pays as premium is higher than what a 500,000 reduced
Decreasing.
benefit
Okay,
pays
okay,
as
okay,
premium.
okay,
Okay?
okay.
Mhm.
Got it.
So we've seen that the example is here. Then we'll move on to
Increasing.
increasing term. Okay, an increasing term policy has a death benefit that grows larger over the length of the time. And this is the increase may occur over a year or on a scheduled basis, such as every 5 years. The death benefit increase may be a set dollar amount or a percentage of a face amount. The total
Mm,
amount of the increase may be limited to a maximum death benefit. Okay, the premium
mm,
increases in proportion to the increase in the death benefit. If the death benefit increases by 10%, so too will the premium. So why would you want to pick increasing term policy? The policyholder expects an obligation to increase, so it might be due
yeah.
to inflation, or the policyholder will also pay a lower premium cost for an increasing term policy than by acquiring additional coverage in the future. So these are
Mm,
reasons why people may want to go with increasing term benefit. The benefit
mhm.
of an increasing term policy is that the death benefit increases even if the health of the insured declines. Thus, it provides the insured with more coverage, protection in the future at any time when they may not qualify for life insurance at all. Okay?
Makes
Then we
sense.
move on to term insurance premium. But I want to step back to decreasing death benefit. I want to establish something. I want to be sure that the premium doesn't increase. So, okay. The premium on the decreasing term policy are lower than the premium on the level term policy of the same face amount. Benefits are paid. Okay, yeah, so it's just a overall this thing. They don't have um a percentage decrease in premium like we have of that of increasing benefits. Okay, I just wanted to quickly
Um, in
establish.
increasing, does the payments change as well?
Yes, payment change.
Oh, okay.
The premium changes in proportion to the increase in the amount of the benefit. Because the increase can be either two ways, either based on specific dollar amount or a percentage of the death benefit.
Okay.
So move on to term insurance premium. Okay. Now,
Okay.
all forms of life insurance, not just term, charges premium to the policyholder. Okay, the premium is the cost of the life insurance coverage for the life insured named in the policy. Premiums can be paid monthly, quarterly, semi-annually, or annually by check or by pre-authorized withdrawal. Generally, term insurance premiums are level over the term, okay, with the exception of increasing term
Mm-hmm.
insurance. You see that?
Mm-hmm.
Yeah, that's that. Okay. Now, there is also provincial charge. You see, and provincial charges a premium tax on the premium, which is usually 2 to 4%, which is included in the premium cost. So all these things they are talking about regarding components of premium calculations. These are not something that we sit down and start explaining to this. And these are one of the aspects of this course that I just believe just for knowledge sake, because we're not going to
Mm-hmm.
start dissecting it to client. We just run the software and then voila, we get the answers and then we
Figures.
show it to the client. Okay. We don't just start testing, but it's good to have the understanding of what runs behind the scene of the numbers that we come up with. Then another contributing factor to premium amount is the modal factor, okay, that is charged by insurance company. All right, so we're going to be looking into more of this modal factor in chapter 4. We saw a sneak peek of it in chapter 1, but more details we will see in chapter 4. Now here we're going to see how premiums are set. The premium is determined by mortality cost of the life insured and the face amount of the policy. For example, a 10 million face amount will have a higher cost than 100,000, and the administrative expenses of the insurance company. You see, the face amount and the admin cost of the insurance company, those are factors that contribute to how premiums are set, okay? Premiums differs between insurance companies for an equivalent face amount. Some insurers have higher administrative expenses than the other, and they differ in their mortality calculations. Okay. All right, let's go on to mortality cost. Now, mortality cost approximate the insurance company cost of paying out death benefits. So the insured probability of death is intended on risk factors, that is age, gender, health, right? So all those things we talked about earlier, all these are what contributes to the mortality this thing of the client. Now, the insurer then classifies the insured into a group of similar people within the mortality experience. Okay, so now we talked about age, we talked about gender, and we talked about
Lifestyle.
the lifestyle and all those things. So when all this information are fed to the insurance company, they put similar, you know, there are classifications of individuals with similar all these traits together.
Factors.
Yes, and then with their own experience, that is with insurance companies' known mortality experience. And each year, insurance policies estimate their mortality cost by multiplying the face amount of the policy by the probability of death. So the formula for calculating mortality cost, okay, is what? By the estimated cost of is by multiplying the face amount by mortality of death, by the mortality of death. So the estimated mortality cost of the life insured is determined by how much premiums that must be paid. So once they've done this now, that's how they come up with how much of premium that must be paid. Okay. And that's why the moment we put gender and date of birth, we can almost all the time come up with an estimated premium price for that individual. Then another thing that contributed to the cost, you see, of that insurance company incur is expenses. An insurance company has many administrative expenses to pay from the revenue it earns. Premiums are an important source of that revenue. Some of these expenses include sales commissions. For example, you and I, that's how we get paid, sales commissions, right? The insurance company pays us our sales commission, marketing, salary, processing applications, and undertaking medical exams, aging and administering the policy. You see, there are some policies that we before they are issued to client, the insurance company will send a nurse to the client's house to do some tests and do all those things. All those things cost the insurance company money, right? And also investigating claims and paying death benefits. All those are expenses that the insurance company incur. Okay. Um, Insurance company also invest, okay, the premiums and then they get returns. All right. Some of these include commission, that administrative, okay, investigative process. All right. So we move on to renewable versus non-renewable um um term
Term
insurance.
insurance.
Okay. So just like the name says, renewable, the term insurance can be either renewable or non-renewable. A non-renewable term is one that expires at the end of the term. If it's 10 years term, at the end of that term, it expires, and that is it. And if the policyholder wants to continue coverage, he or she will have to apply again and provide that
Mm.
he or she is insurable, that is in good and moderate health condition. Okay. With a renewable term policy, the policyholders has the right to renew, okay, and be guaranteed to renew the policy regardless of their health condition. And this is a powerful thing because you see, I have a client that I got insurance for early last year, right? So this year now, she wants another policy, and I checked with another provider. Lo and behold, there was something that was found in her medical this year.
Oh,
Now
wow.
she's no longer qualified to get another policy. But imagine she had not had that one from last year, right? So now that one that she has from last year now, she has option now. She wants to renew it because that one is a term insurance. So we're trying to get permanent one now that was declined. So now she wants to renew this one now, regardless of her current state of health. The insurance
Mm-hmm.
company is her right now to renew because there's a renewable option in that plan. So that's what
Oh,
that's.
so she took a wrong insurance when she started?
No, no, it was not wrong. It was term insurance because of
Oh,
affordability at the time, right?
oh, wow.
Mm. Okay. So yeah, so that is that. Then now policyholders' right to renew and blah blah. And then the right to renew is usually limited to a certain age, e.g., age 70. Premiums are higher for renewable term than for non-renewable term. You see, because of the guarantee
Mm-hmm. Mm-hmm.
that comes with it. You see, every pet has its own price tag. All right. So, but it's a price tag that is worth it. So if you go with a renewable term, it's a little bit more expensive, but again, you have peace of mind that you have that option to renew regardless of the person. So why pick a renewable term contract? Well, there may be doubt about future insurability. For example, a client's family health history. So if you have a family health history and that you are not this thing that it might you are worried that this might affect you, then go with the renewable term option. So there's example there, and then there's renewable provisions. The premiums upon renewal may vary depending on the policy provisions. Okay, so let's look at this one. Renewable with guarantee rate. So again, you can even lock in your renewable with a guarantee rate, that is the amount you'll be paying upon
Mm,
renewal. For example, you're taking term insurance today. So you can, maybe your premium you are paying right now may be $100. So you can as well as locked in what your premium will be in 10 years time when it renews. So instead of $100, now it may be 120. So you can lock in that as well. That's what we call renewable with guaranteed
mm,
rate. You see, while the policy holder of a renewable policy is guaranteed the right to renew. The policy at the end of the term, the new premium will reflect the age of the life insured. Okay? Of the
mm-hmm.
life insured at renewal. Most policies provide a guaranteed schedule of renewal rate when the policy is first issued. Okay? So there's an example here for that. Okay? You see, age of each at renewal, annual premium for the new term. Okay, and these are the way this is done. Then there's what we call also re-entry term with adjustable rates. Okay. Now, remember we've talked about um guaranteed renewal options, right? And then we also looked at the renewable options with guaranteed rates. Okay. Now, this particular principles now is on re-entry term with adjustable rates. Okay. Re-entry term is a form of renewable policy, but is subject to two renewal rate schedule: a guaranteed renewal rate and a lower rate that is adjusted for a good health of the life insured. See, this is two. This one, the first one is okay, a guaranteed renewal rate. That's the one I mentioned earlier. You are taking term insurance today, for the next 10 years, you'll be paying $100. And then when it renews for another 10 years, after 10 years, that person is guaranteed to be paying $120 every month. So that is a guaranteed renewal rate. Now, this re-entry option gives you the carrot and stick all in one. It gives you the combo. It gives you the, how do I put it? In other words, you get the guaranteed renewal rate to lean on, or a
Okay.
lower rate that is adjusted for the good health of the life. That is, you have this guaranteed rate in your back pocket, but you can also
Okay.
jump on a bandwagon and say, hey, you know what, insurance company, I have been in my best shape ever. I'm doing well, I'm eating well, I'm exercising. I think my health is so fantastic that you might want to consider this my guaranteed rate. You
Okay.
have that option to jump in. Then the insurance company will do all their necessary stuff, and they might come up with a better rate. Maybe instead of paying 120, the person might end up paying something lower. This is what this re-entry option stands for. It guarantees renewal, but bases the renewal premium on the health of the insured. If the health of the life insured is better than when he first took out the policy, a lower premium is offered. And if the health of the life insured has deteriorated since he first took the policy, he still has the right to renew the policy, but the guaranteed renewal rates are higher than those for a renewal policy that does not have the re-entry provision. You see
Mm-hmm.
that?
Mm-hmm.
Mhm. All right. So because the life insured does not have to provide evidence of insurability with the guaranteed renewal policy, the insurance company is taking the risk of the continue to provide the insurance. So yeah, see, every time you see evidence of insurability, this is the 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 point where the insurance company has to ask for evidence of insurance, like, okay, what risk are we taking on this person? Can we assess this person's health to know exactly what we are getting ourselves
Okay.
into, right? And every time that we are making decision to limit that ability on the life insurance part, the way the insurance company cover their butts is by increasing the premium, because
Premium.
they feel they are assuming risks that they know nothing about.
Yes.
And that is why in a guaranteed rate is higher. Guaranteed rates are always higher because insurance company is saying, well, you are not giving us any evidence that you are insurable. So we are taking risks that we know nothing about.
Mm-hmm.
Make sense? Okay.
Mm-hmm.
So we fly over that. And then re-entry policies may be a good deal because the life insured retains some of the risk that he or she's health has deteriorated by the time the policy is up for renewal. Yeah. Okay. Convertible term insurance. So again, this one is a term insurance, but comes with an add-on that enables this policy to be converted upon the end of the term. So which means that this person can now convert this policy to a permanent insurance. So a convertible term insurance policy can be switched or converted from a term policy to a permanent life insurance policy without evidence of insurability. Again, evidence of insurability. Know this term, understand it. It will be coming everywhere. You understand? Whenever you see evidence or no evidence of insurability, just know that this person is not showing insurance company anything about their health. Okay, because the life insured does not have to provide that he or she is in good health, you see, for the conversion. So the permanent life insurance policy ends with the death of the life insured. The permanent life insurance policy include whole life insurance, M100, and universal life. And don't worry, we're going to be breaking all this down in the subsequent chapters, okay? Premium for convertible term insurance are higher because the policyholder may make the switch and expose the insurance company to additional risks beyond the original term. You see, so this policy, this term insurance that comes with add-on that enable the policy owner to convert to permanent insurance, the premiums are higher. Like I told you guys before, anything that will make that is making insurance company to assume unknown risk, they cover their butts by increasing the premium. Okay. Conversion times or age are specified in the insurance contract. Okay. Now, why would the conversion time specified may be the 5th year, it may be the end of the term, but there will still have to be stipulated in the initial contract. Okay, so why pick a convertible term contract? Well, to have the security of knowing that it can be converted, like this my client now. So if we had a convertible this thing, right, the client may have option to convert to permanent. But again, it can be freaking expensive. It's not just to have that option, but it's important to establish that you can afford that option before dabbling into it. For some people, it might be better to just take permanent insurance right off the bat from the get-go, right? Also, having that option provides assurance of a future death benefit. And then when there is any doubt about future insurability, for example, health or whatever, it's always good to have something to fall back on, as in that example, okay? And then we'll move on to this concept, these principles. Please note it. This is exam lovers. The examiners loves this. They test it. You could see 2-3 questions from these principles. It's called incontestability and suicide provision. Incontestability and suicide provision. Incontestability period is a period to which insurance company have to ask any questions, to prove anything. Once that period is gone, then that we enter incontestability period. Contestability period is the first 2 years of the policy. After the first 2 years, then nothing can happen again. Then we have suicide provision. A permanent policy issued after conversion is considered an exception of initial term policy. So the policyholder is exempted from a new contestability period and exclusion period. Contestability period is the 2 years following the issue date of the policy. Okay, that's what I just said, contestability. That's the period that the policy can be contested. You see, contested is from the word contest. You can contest, you can query, you can, Now, during this time, the insurance company can void a policy if it discovers a material error was made in the application, the insurance company can void that policy. But a material error is an error that will have affected whether the policy will have been issued. After 2 years, a policy can be voided by the insurance company only if fraud has been committed by the policyholder. You understand? Only fraud, otherwise nothing more. Okay, so the suicide exclusion period is the 2 year following the issue date of the original policy. So suicide exclusion, if the person take policies today, right? In the first 2 years, if that person commits suicide, that policy will not pay. But after 2 years, the policy will pay. The person can go and commit suicide, the policy will pay. Okay?
Got
Note
it.
that the contestability period and the suicide exclusion period applies to all forms of life insurance, not just
Not
convertible policies.
convertible.
Both permanent, both term, this is a standard, you understand? Okay, we move on to attained age versus original. Ooh, I just want us to finish chapter 2, then we'll take a break and then we'll come back, okay?
Yes, ma'am.
So attained age versus original age. Now, when a policy is converted, the permanent life premium that replaces the term premium may be based on the attained age of the life insured. The age of the life insured on his last, nearest, or next birthday, depending on the administrative policy of the insurance company. So this is attained age. Now, I'm going to go slowly on this concept because this concept, the way they test it can be confusing. So I need you guys to pay close attention, please. Okay. Now, when a policy is being converted, for example, someone is taking policy when they are 20 years old and it's for 10 years. Now they are converting it when they are 30 years old, right? Now this conversion is going to be on their what? Attained age. Okay. So now, yes, we know they are 30, but there's another angle to it. The age of the life insured, the attained age of the life insured, which is the age of the life insured on his last, nearest, or next birthday, depending on the administrative policy of the insurance company. So in this attained age, for example, you see, this person is born January 1st. Okay. Now, this is July 5th. All right. Now, the next birthday is January 1st. Okay. Now, we're in between January 1st and July 5th. And then we also have gap between July 5th and January 1st. So the attained age of this person now, if this person is doing this conversion, let's say on this January 1st, this person turns 30. On the next January 1st, or January 1st of 2023, this person is 30 years. January 1st of 2024, this person is 31. And then we are standing on July 5th. How old is this person?
Mathematical.
So on July 5th, between January 1st, 2023 and January 1st, 2024, which one is the nearest age?
That is not his next birthday.
Sorry?
Wouldn't that be his next birthday?
That will be his next birthday because this is already July 5th.
Mm-hmm.
Okay. But if this was happening on June 30th, this person age would have still been 30 years, right?
Okay.
So this is how time sensitive insurance contract is.
Okay.
You know, I've had some people, they'll reach out to me, I'll run quote, they're happy, and then they disappear to the thing, and then they showed up a month later, and I show it to them, oh, sorry, your premium is now this. They're like, oh, Joy. Oh. I said, but you are now 1 year older, according to the nearest age now, right?
Mm.
You
So
get
what,
it
their
right.
premium expired?
Sorry?
Like they missed their date to renew?
No, I'm just giving you an example of when we run quotes, not when policy, once your policy is
Oh,
established, I mean, when somebody comes now, I run quotes based on their age,
oh, okay.
maybe
They
they,
now
they
want to
are,
sign up, but the time
yeah,
has
they
passed.
didn't sign
Oh,
up, they have, they think, oh, they think they are doing you a favor, right?
oh,
And then they
got
won't
you.
pick your call. They won't. Then 1 month later, 2 months, they say, "Oh, see that thing we talk about. I'm ready now. Okay, we'll start again."
So they have to
Because
start
now
all over.
you are a month or you are 1 year older. Now I say, no, we may just when you get what I'm saying. So
Yeah,
yeah,
but it doesn't matter. Your birthday has come.
yeah,
Yeah.
we are now tracking the nearest birthday. And now, the original age of the life insured, the age of the life insured when the policy was first issued. Now, premium from the permanent policy are less when the original age of the life insured is used. For example, Manuel bought a term life insurance policy on August of 2020. His date of birth is November 1st, 1986. His premium will be based on age 33. If attained age is based on his if attained age is based on his next birthday, then attained age
Mm,
conversion refers to the attained age of the insured at the time of the conversion to the permanent policy.
mm,
If in the case of an original age conversion, or retroactive conversion, a lump sum payment must be made when the policy is converted that brings the policyholder in line with what his cost would have been has he chosen the permanent policy in the first place. And this
mm,
can be a significant sum. Oh, lo, 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 lo.
mm.
Do you guys see that?
Yeah.
Yeah. Okay. So we have
It,
example here. Please take time, read through example carefully because if I start reading through everything, even right now, we need to advantage and disadvantage of term life insurance. See, like I said at the beginning, term insurance has its advantage, okay? And then term advantage and disadvantage is in a table here, all right? So number one, it has low initial cost in the early years of the policy, and the premium of the term insurance will be lower than those of the permanent. And then these are the disadvantages in this table. Okay, go through
it's,
it, please. All right. Then that's where we have need for term insurance. As a general rule, term insurance should be used to protect against temporary risks that will end before the life insured reaches age 60. Okay. Yeah. So term insurance is for a temporary risk. So, and that is why when we say temporary risk, life is not temporary because we don't
mm,
know when the end will come, right? So when we're
mm,
looking at term insurance, we should be able to have that disconnection between the temporary risk and the risk of life. So if we understand this concept like that, then it's going
mm,
to help us make decision as to which risk we need to cover with term insurance and the one we need to cover with a permanent life insurance. Okay.
Mm.
So there's short-term risk, and then there's limited cash flows and all that. Okay. So, and that brings us to the end of
Ah,
no, the end of chapter 2, my darling.
the end of the morning class, so
No, not the end of the morning class yet.
it's 7 minutes past 7.
Sorry.
The children were hungry.
So because the class, we need to finish chapter 3, and then
Chapter 3
even
is
if
like
we
two
cannot
hours.
it's 5 to 8.
It's not to Jesus. God in
Yeah, it's 5
heaven.
to 8. So if we can't do Q&A, at least with the breakdown of this text, I'm sure we can attempt on this chapter by chapter quizzes ourselves. But right about
Yes.
now, I would like us to take a break, and
Yes.
then we will be back to right into chapter 3. Don't worry, I got you guys. We got this,
Excited,
right?
excited. Yeah,
How many minutes break do we want to take? 5 minutes is okay, guys. 5 minutes. See you in 5. Break. How are we liking the class so far? You guys should not hate me, please.
it's looking good.
Okay, so we are in chapter 3.
Wow, 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 wow.
So here now, we've looked at the concept of temporary insurance. So now we are diving into permanent insurance. Oh boy. A permanent life insurance is exactly what it names suggests. It's permanent. It provides insurance coverage over the entire life of the life insured and ends upon the death of the life insured. Okay. It does not need to be renewed. It doesn't need to be converted. It doesn't need all the yada yada yada. Okay. So but we're going to see what are all these permanent insurance. Okay. How permanent insurance differs from term insurance. But right off the back, you can tell, can't you? Term insurance
Yeah.
is intended to provide protection against the risks that are temporary, and then insurance does not provide adequate protection against the risk of death, right? A risk that is
Yes.
associated with death due to expiration of the policy after a specified period of time. Okay. Um, like level term insurance premium, for um premium for permanent life insurance are the same over the entire life of the policy. Again, the fact that this permanent insurance is permanent doesn't mean that the premiums changes over the course of the age and all that. No, the premiums are the same. For example, if you take a permanent insurance and you're quoted to be paying X amount today, you're going to be paying that particular X amount for the duration of the policy. Okay. Now, in the early years, the premium for a permanent policies are higher than the premium for temporary policy. However, in the later years, term insurance becomes prohibitively expensive. Yeah, like if you were to compare them side by side. For example, when I'm comparing term insurance with permanent insurance to people, I always run the term insurance that have guaranteed renewable options, okay? Because that
Okay.
shows us what the premium will look at like in 10 years' time, in 20 years' time, right? Now,
Okay.
when you look at term insurance versus permanent insurance premiums today, that term is cheaper. But when you look at what the term insurance will convert to in 20 years' time, in 10 years' time, and you compare it with that permanent premium that never changes, then that term insurance premium becomes freaking expensive.
Imagine.
There are different types of permanent insurance. You see, whenever I talk to people like this and I get to this point and I tell them you have whole life, you have universal life, and they're like, but John, which one do you recommend? Okay. Anyways, what is whole life? I'm sure you must have heard this before, right? What is whole life? Whole life policy provide coverage for the entire time of the life insured. And by now, when we say life insured, of course, you guys know what that means by now, right? Premiums remain level, has a set benefit, and builds up a cash surrender value over time. It's called CSV. Whenever you see CSV, you need to be writing down all these terminologies, because right now we are now beginning to get into the meaty part of this course. Okay, so CSV stands for cash surrender value. Write it down. Okay, write it down. Cash, and if you don't have a note for this course, at the end of this class this morning, find one or get one from Dollarama. It will really be helpful, you see, because sometimes we can't trust our brain enough to hold this amount of information, especially when we have so many things that we are processing, right? So you can get a cheap one from Dollarama, and that would just be good. Or around the house, you might find something. Okay, so that is CSV stands for cash surrender value. Now, when applicable, the policyholder may be entitled to receive payment of that CSV. You see that at the more we go further, you are not going to see cash surrender value again. You'll be seeing CSV. If you don't note it now, when you see CSV, you're like, what are they talking about? It may even be in the chapter by chapter quizzes. You're like, what is CSV again? What is CSV? So if you write it down, you just reference your note and you'll be fine. Okay. Now, payment of that CSV minus any surrender charges is the policyholder surrender. If the policyholder surrenders the policy prior to the death of the life insured. Okay. Now we will move on to M100. Now we're looking at types of permanent insurance. So this whole life, what you just read few lines in whole life, that's not all there is to whole life. We're still going to eat deep into whole life, but they've given us M100 right now, so let's talk about it. M100, also called P100 or M100, provides coverage for the entire life of the insured. So it doesn't mean that, okay, when the person turns 100 years, it will stop. No, it means that premium will be paid till age 100. And after age 100, no payment paid again, but the person will be covered for life. Okay? This T100 provides coverage for the entire lifetime of the life insured, you see. And then normally, it doesn't provide any cash surrender value. And policy matures at age 100. That is, premium payment stops at 100 years of age. But life insurance coverage continues. Okay, so again, that is, so in other words, we could see the three types of permanent insurance. Okay, we have whole life, we have term to 100, and then universal life. Okay, now, universal life, this will be discussed in detail in chapter 4, but it provides coverage for lifetime of the life insurance. It has two parts to the policy, an insurance component and a savings component. It has a basic premium and an option to deposit more than the basic amount. This is called the excess premium, which goes into the savings component. It has a minimum death benefit with an option to increase the death benefit, and the savings account offers the policyholder the different investment options, and the accumulated savings and investments are tax sheltered and form part of the death benefit. In bracket, tax deferred if funds are withdrawn prior to death. Okay? Now, overview of whole life. See, what they've done is that they just gave us a snippet of the three forms of permanent life insurance, which is whole life, term to 100, and universal. So now we're going digging deeper now into each of them. And of course, the first one is overview of whole life insurance. Okay, So please, I know it's been a long class, but stick around with me. Trust me, this class is going to be worth it, because if you guys get everything I've been explaining, you go now do your quizzes. By the time we are done with this, you'll be good to write your certification. Okay?
Okay.
Yeah. Okay. So am I not doing good job so far?
Fabulous, fabulous.
Let's see what I mean, guys. So let's keep it moving. So yeah, overview of whole life. Whole life insurance is a form of permanent life insurance that typically guarantees the premium. Okay, so your premium doesn't change as your ages increases. No, your premiums is the same, and the death benefit and the minimum cash surrender value for the policy it is sometimes referred to as straight life or ordinary life insurance. Okay, is permanent. Your premium doesn't change with age. Everything is known, right? Now let's look at the diversification, the coverage terms, as it applies to whole life. Whole life is a form of permanent death benefits, and minimum cash surrender value are guaranteed. Why are they saying minimum CSV are guaranteed? Well, as long as premiums are paid, coverage is lifelong. The policy does not expire and cannot be cancelled by the life insurance company.
Okay.
Okay, so it's only this thing only the policy, this insurance is only cancelled or whatever if the life insured fails to be the policy holder or owner fails to pay their premium.
Okay.
All right. Okay. Even at that, the policy doesn't lapse immediately because it has what we call cash value. So we'll go into that. Let me not just jump ahead for you guys. Now let's talk about policy reserve. Recall that the premiums collected by the insurance companies are used to cover the risk of death. When the policy is its early years, the premium charged is higher than the amount needed to cover the risk of death. The excess of the premium creates a policy reserve. See that? And the policy reserve is invested by the insurance company. In later years, where the mortality cost risk of death is higher, the premiums collected do not adequately cover the risk of death. The investment growth from the policy reserve is used to offset this shortfall. So how are premiums set? So let me just break down what we just read briefly for you guys, because we just read something very briefly, but a lot is wrapped into these few sentences that we just read. They talked about premium. They talked about premium reserve. They talked about investment growth, right? Now, what happens when it comes to a permanent insurance, in this case, whole life policy, as we are looking at it right now? When the premium comes in, let's say the premium at this when the premium comes, or when the person is insured, right? There's what we call pure cost of life insurance. Pure cost of life insurance is what it costs the insurance company to insure an individual, to protect an individual in a particular year. Remember, we talked about mortality cost earlier, right?
Yes.
So in any particular year, insurance company knows how much it will cost them on that person. So that's what we call cost of pure insurance. Okay. Now, that cost of pure insurance is not the same every year, because as the person age, so is the cost of insurance goes up for the insurance company. But on the front end, that's what happens on the back end. But on the front end, insurance company gives us one amount that we pay. But on their own back end, their administrative calculations, that pure cost of insurance goes up.
Okay.
And as a person goes older, that cost of pure insurance for that person goes up. Now, how does insurance company keeps the gates in a way that we are not seeing what goes on behind the scene, but as a broker, I can run the query to see what the pure cost of insurance will be for an individual as the year progresses, right? But that aspect of analysis is not made available to the client. So all clients know is that, oh, I'm 30 years old. I'm taking whole life policy. Insurance company tells me, okay, I'm going to be paying $250. All clients know is what they are paying, right? And how that money grows over the years. So when the money comes in, let's say this individual is 30 years old, please follow me. You need to get this, okay? Because if we start building on this, you don't get this foundation, you might struggle, okay? So
We're trying.
This person is 30 years. Now, whole life says you pay 250 per month, okay? So now, when this 250 comes in, it depends, the money is withdrawn from the client's account. All clients sees on their end is, oh, okay, insurance company, life insurance, 250 every month, done, right? But when the money gets into the hands of the whole life insurance, it splits into two. Are you following me?
Right here.
It splits into two. One goes into pure cost of life. Then the other end goes into what? Right here, is here.
Life.
Goes into reserve.
Policy reserves.
That reserve is not sitting down there as a reserve account. No, the reserve is an investment account.
Okay.
You see? So now you are seeing how this reserve is treated for an whole life policy. And then we are going, when we get to universal life, you see how this reserve is treated for universal life policy. Right? So now this reserve is invested by the insurance company. And then as the year goes by, because every month as the client is paying, the reserve is increasing, the investment is increasing, right? Because as time goes up, as the person age, to get to a point that the money coming in, the cost of insurance will start swallowing the entire policy. Because the money comes in. Instead of splitting into two, there is nothing left to go into reserve again. Why? Because that cost of insurance is growing is going faster. As the person is going bigger, you understand? But at that point, because this reserve has been growing over the years and the investment has been growing, then the investment growth from that policy reserve will now start being used to offset, because that cost of insurance at a later years, especially for people that have longevity, the premium may not even be enough for that cost of insurance. So what will now fund that cost of insurance to keep the person insured till death will now have to be the investment growth of this reserve. Make sense?
Yes.
Now, how are these premiums set? So now I've told you now, how does the insurance company keep the gates and set this premium that it will fulfill this promise? Because people ask me all the time, and I've had people in the past, people have had situation where they've received letter from insurance company asking them to put more money, otherwise they'll lose their policy, but that doesn't happen anymore. And that doesn't happen in Canada. I hear of those stories mostly in the US, right? Now, what are the strategies, the parameters put in place by the insurance company to ensure that there's never going to be a time that this policyholder will have to be asked to put more money. You see, these are when numbers, statistics, you see all those mortality cost and everything we're talking at the beginning, right? Those are the data that help insurance company keep these gates tight. Okay. Now, the premiums for life insurance are calculated based on an assumption about mortality cost, expenses, and investment returns. These assumptions are projected over the life of the insurance contract. Okay, so note down these three terms because they're going to give you these questions. They'll give you these answers and throw in one wrong one there and ask you to find what is not part of the basis for the calculations of insurance premium. Okay, you're going to see mortality cost is 1, insurance company expenses is 2, and investment returns is 3. Any other one will be your answer. Okay, now, these assumptions are subjected as projected over the life of the insurance contract, which could be as long as 50 or 60 years. Okay, thus, insurance company takes a very conservative approach in their assumptions and estimates. You see, that is the way they are keeping the gate. They don't go ballistic outside and telling you, you see these reserves we are investing, we are getting 10% return. No, they go conservatives on those returns. Even if they have a statistics that gives them higher returns, they keep it in a conservative manner. Make sense?
Mm-hmm.
So
So I'm taking you back.
that
Factors influencing how premiums are set: modality, cost, insurance expenses, investment returns, and impacts of model factors. Are they 4?
no. Okay, sorry. Give me one quick second. Where are we, sir? Premiums for life insurance based on assumptions about mortality, cost, expenses, and investment returns. These
Okay.
assumptions are projected over the life of up to 60 years. Thus, insurance
Okay.
companies takes a very conservative. No, it's up.
Okay. Okay. Is this 3?
Yes, it's this 3. Yeah.
Okay.
Now, what are mortality costs? Okay. We talked about it briefly earlier in chapter 1. Okay. Now, mortality costs approximate the insurance company's cost of paying out death benefits. Now, there is a formula for calculating mortality cost. That's why I say you guys should get this thing. But there's some in your Oliver, there is a formula sheet there, so you can
Yeah.
download it. These formulas
Okay.
are there too, okay? But if you have a note and you're writing down your formula as we go, you will be able to tie it into the concept than relaxing and say, okay, so since there's a formula sheet, I'll go there. You choose, but I will recommend, writing it down as we go, then you know the concept that particular formula is tied into. Make sense?
Yes.
Okay, so now let's look at mortality costs, right? Now, the mortality cost is annual estimate of mortality cost. Annual estimated mortality cost is equal to a policy's face amount multiplied by probability of death for that year. Let me move this thing up a little bit. Divided by mortality death of the life insured during the year. So that is your formula for right there. Okay, annual mortality estimated cost policy face amount multiplied by probability of death of the life insured for that particular year. Okay, with term insurance, the policy could expire before the death of the life insured. There is a chance that the insurance company will not have to pay the death benefit. You see, that's why insurance company they love term insurance when it's a short period of time because they know that the risk of those policy
It's
crystallizing
lower.
is very slim.
Mm-hmm.
You see, uh-huh. But with a whole life policy, the insurance company will eventually have to pay the death benefit. Eventually, there is no other way around. It may be delayed, but it will not be denied. You understand? And
Mm-hmm.
that's why you see, when we talk to people, you see, death is something that is certain. We may not know the time, right? So why not make it count? We will go someday, anyways, right?
Mm-hmm.
And some people that are close to me, that I can be real with them, I say that even if you are not a millionaire in life, you can choose to be a millionaire even in your death by the things you leave behind, right? Now, in calculating premiums, let me not digress because we don't have much time. In calculating in calculating premiums for a whole life policy, the insurance company spreads the insurance company spreads the cumulative annual mortality cost over the anticipated life of the insurance contract. Now, that is, you see, one of the this thing, the mortality cost, one of the ways the insurance company calculates the premium. We talked about it earlier, right? So now what they do is that they spread that, okay? They spread that cumulative annual mortality cost over the anticipated life of the insurance contract. The mortality cost is one, the insurance expense is the second one. So the premium of the whole life policy covers the insurance company's administrative expenses. And what are these administrative expenses? They are marketing expenses. One of their marketing expenses is different ways they market. Some insurance company runs adverts, they have
Mm-hmm.
brochures, road shows, and all those things, right? Like last last weekend when we had our event, right? We have insurance companies that give us their marketing dollars to fund that. That's why we did not charge anybody that came for that event, right? So those are marketing expenses. Then salaries and commissions to agents. Again, well, one of the expenses our insurance company incurs is our own commission as well. Then processing the applications, paying medical exams, paying income taxes, investigating claims, and paying debt benefits. All these are expenses that the
Expenses.
insurance company incurs. Okay. Now, with a whole life policy, the insurance company must estimate the future cost of all these expenses, right? And then the third this thing is investment returns. Okay. Recall that mortality costs are lower at the beginning of life insurance policy and higher towards the end. I explained that earlier. When I was talking
Mm-hmm.
about the cost, the pure cost of life insurance that runs behind the scene, right? So those costs are higher towards the end. So therefore, insurance companies invest the policy's reserve to achieve positive investment returns, which can then be used to offset the higher mortality cost later in the life of the life insurance contract. So the life insurance company must make an assumption about these returns, about the returns it will make on the investment over the duration of the life insurance contract. When calculating the premium for the whole life insurance contract, stock market history has shown time and time again that investment returns in reality can differ greatly from projections. That's very true.
Mm-hmm.
And that's why we read earlier why the insurance company goes really, really conservative. Okay? Uh-huh.
Mm-hmm.
So impact of modal factor. I think this concept, I'm explaining it well so far. And if you
Yes.
guys follow the way I'm breaking it down, you guys will be fine. You've seen the three major factors to setting of
Premium.
insurance premium, right? The modal factor, the what's the second one again?
Expenses.
The expenses. Thank you.
Mm.
And then the third one is investment return. Okay, there you go.
No.
There you have it. Now, if they ask you to find the right answer. So just look for any of these three. If they ask you to find the wrong answer, then just know that anyone in addition to these three will be your wrong answer. Okay. This
Exactly.
exam is multiple choice, so it's not that deep. Once you understand the concept, you know what to see and what not to see in an option. There you have it. Okay. And just pay attention to the question when they say find the right and find the wrong. Most of the times, that's what they do. They ask you to find the right answer. So if you are so excited and you didn't read, always read the whole question. If you're so overexcited and you see the word you're familiar with and you didn't finish the question, there might be somewhere towards the end of the question where they're asking you to find the wrong answer and you go and find the right answer. So those are the areas I see people really goofed in most cases. Okay. Impact of modal factor. Life insurance premiums are normally quoted on an annual basis and premiums are payable in advance. Okay.
Okay.
Now, we may be paying premiums every month, but that doesn't mean they are quoted every month. Okay, they are quoted annually. So the annual premium paid at the beginning of the year gives the insurance company the funds to invest for the year. However, a policyholder is given the option of paying the premium monthly, quarterly, or semi-annually. When a policyholder chooses one of these payment schedules, the insurance company compensates for not having access to the full sum for the year by charging a modal factor to the policyholder. And that's why when we run illustration for clients, clients that pays annually pay lesser than client that pays monthly.
Okay.
Okay. The modal factor means the policyholder pays more for the premium. The modal factor reflects lost investment income that the insurance company could have earned on an annual premium. So when an individual opts for a monthly, quarterly, or semi-annual payment schedule, the premium paid will always be higher than the annual premium due to the modal factor being applied. And the way that modal factor is calculated is monthly premium is equal to annual premium multiplied by the modal factor. Okay?
Mm.
I need that.
We are moving.
Yeah. I'll see. So a sample of modal factor for term and whole life policies are shown in the table below. So in this table, you see sample of modal factor. Again, they will give you questions around modal factor, but they're not going to give you tables like this, okay? So questions they ask around modal factor are pretty much minimal. Let's look at this example. Victor bought a whole life policy with an annual premium of 956, but he wants to pay the premium monthly. The modal factor is 0.088. His monthly premium will be this. And this is calculated on 956 multiplied by 0.88.
Okay.
Okay? Mhm. So that is on that one. Now we'll move on so we've looked at modal factor. So we've looked at modal factor. Now we are moving on to premium options. Okay? Now, please pay attention to this, please. Okay. Premium options never increase regardless of the way they are paid. Okay. Depending on the whole life insurance contract, the policyholder may have several options for paying premiums, such as the following options discussed below. Okay. There is ongoing premium. Okay, so what this is telling us is that once your premiums are locked in, they are locked in. They're not going to be doing tumble or pendulum swinging in one direction to the next. No. Now, the ongoing premium, this is the traditional premium that is paid at the fixed price on an ongoing basis for life until the policyholder surrenders the policy. You see, when you hear surrenders the policy, this is the term used for more or less like dumping the policy. More or less like you saying, you know what, I'm not doing this again. I'm done. Or more or less like the policy owner says, I'm not interested again. So that is the term used in those instances are referred to as surrendering of that policy. Okay. This form of premium can be called a lifetime pay policy. For example, Helena is 40 years old, a non-smoker, and in excellent health. She just obtained a 500,000 whole life policy on her own life. Her premium will be 1,165 annually, and they are guaranteed to never increase. Okay,
Okay.
so we'll look at Helena. We know her premium, we know her face amount. Okay, so now face amount. When you hear face amount or you hear death benefit, those are two same words. It means the amount that will be paid out when the person died. That's why they are called death benefit.
Okay.
Is the amount that the person take coverage to their tune of. Okay. Now let's look at single premium. The premium can be paid once in a lump sum. Okay. So one can take a like this, you take a policy, we can quote it, you take $1 million policy, maybe the premium might be 100,000 or it might be X amount. Somebody might choose to, I have people that choose to pay such a lump sum. Maybe they just make some money and they don't want to bug themselves every month to um be paying premiums. They just want it done and dusted. So that can be done. Okay. The policy is then paid up and no other premiums are required to keep the policy in force for the life of the insured. A single premium policy is a paid up policy. So it's paid up, no premium required, and the person is covered for life. Okay. So that is called single premium policy. So we are talking about different kinds of premium, right? Different premium options. What are the options available for one to pay their premium? Note this. So we have ongoing premium. There is single premium. Now we are looking at limited payments premium option. Okay. Premium payments may be limited to a set number of years or to a set age. At the end of the
Okay.
period, the policy is then paid up. And this form of whole life is detailed in chapter 3.6. So there's limited premium, and then we'll also go into death benefit options. So now for the premium options, we have three options, which are the one we've talked about.
Okay.
Now we are moving on to death benefit options. You see, premium options is different ways we can pay our premium. Then death benefit options are different ways we can receive the death benefit. Make sense?
Yes. So the premium options, the ongoing will probably be like maybe month to month.
Month to month, yeah?
Then the single will just pay it off at once and move on with their life.
That's three. That's that. That's right.
How does the limited work? You
Limited
said for
is a specified ones. Do you understand? It's not ongoing, it's not one time. Okay, it's limited as specified. Maybe the person may say, okay, I'm paying first one now. In the next 5 years, the person will pay another one, then another, like as stipulated. And that is why when we
okay.
get here, we say premium payment may be limited to a set number of years or to a set age. Okay. So this limited premium, I use this a lot because sometimes I meet people that are 40 years old and they are doing permanent insurance. And I
Okay.
don't want them to be paying their premium when they are out of active work life, when they are retiring age. You don't want people burdened with or saddled with worrying about their insurance premiums every month, right? So when people are 40
Mhm.
years and I'm doing something permanent for them, I set this limited payment to be paid off in maybe 20 years or 30 years. So
Okay.
that in the next 20 years, their premiums are fully paid and they don't need to worry again. If the person is 35 years old I might set it up to be paid off at 30 years. So that by the time they are 65, their policy is paid off. So even though if they are in retirement, they are not worrying about insurance premium. Make sense?
Makes sense. Yeah.
Yeah. Okay, so let's move on to different options that people, clients have on how they receive their death benefit. And this is called death benefit options. Okay. Depending on the insurance company, the policyholder may also have some choices, some choice as to how the death benefit is determined. The policyholder has a choice between guaranteed whole life and adjustable whole life. Now, guaranteed whole life. As its name indicates, this form of policy guarantees the death benefit and a set premium. The insurance company takes on all the risk with the guaranteed whole life insurance policy due to its assumption about pricing factors. Okay, so this guaranteed whole life, all right, the insurance company takes all the risk, the death benefit is guaranteed, the premiums are set, nothing is moving. Okay, so this is our guaranteed whole life. All right. So in this case now, the insurance company is taking all the risk of whatever the market rate will be or whatever the assumption will be in the future. So they put all those factors into their pricing of initial. Okay. And we move on to adjustable whole life. With this form of whole life insurance, the death benefits and premiums are guaranteed for a certain period of time. That is like 5 years. Okay. And at the end
Okay.
of the guaranteed period, the insurance company will compare its mortality cost projections to its actual experience and will update its assumptions about mortality cost expenses and investment returns. Based on its review, the insurance may adjust the policy by increasing or decreasing either premiums and the death benefits or both. Premiums are typically lower in adjustable whole life policy because the policyholder is exposed to more risk than with comparable guaranteed wildlife policy. Oh, I'm sorry, whole life policy. Do we understand? This is very straightforward. I don't think I
Yes.
need to start explaining. It's very straightforward. Okay. As such, if the insurance company's actual expenses slash costs are higher or investment returns are lower than it has forecast, premiums may increase or the death benefit may decrease. If the insurance company's actual expenses slash costs are lower or investment returns are higher than it has forecast, then premium may decrease or the death benefit may increase. If the insurance company's actual expenses and costs are in line with forecasts, premiums or the death benefit may remain unchanged. While available, adjustable policies are no longer in common use in Canada. Yeah.
Can imagine.
Yeah, I've not even been saying this because with the way things are now, who will survive this one? You understand? So this is not popular. And there's an example there. If we want to go read this example, please take time. But I don't see them testing it a lot. But again, it's good to um, know it. But it's pretty much straightforward. So we are moving on to what? Participating versus non-participating whole life policy. Okay? This is an
Okay.
interesting part. Now, whole
Okay.
life policy. Whole life, sorry, did you say something?
No, I'm with you.
Okay. Whole life policies can be either participating or not participating, depending on how the insurance company handles any surplus that results from the policies. You see, now participating policies offers the policyholder the option of receiving shares of the insurance company's
Oh, I see.
surplus revenue in the form of dividends. So you see, they participate in, just noted that is the one that the insurance company allows you, the policyholder, to be a part of the company. And now, how do you be a part of the company? Is by you issuing you shares in the company. And when you own shares in the company, what is the reward? The rewards are dividend, right?
Yes.
The rewards are dividends. So that is participating for you. So when you buy participating whole life, it means you are becoming part of the insurance company, whereby you receive shares and then in turn you get what is called dividend. Okay. And then we also have non-participating policies that keeps revenues and their surplus are retained, because with the participating company, the revenues and the surplus are shared, they are distributed in form of dividends, but the non-participating, they keep their own. They don't share it because you are not participating, you don't own shares, so you don't get anything. Okay. Now, non-participating policies keep surplus revenues as retained earnings, which increases the company's shareholders' equity. So these ones are just here for their own shareholders. Mind you, these shareholders, they are not talking about you that they insured. You understand?
Mm-hmm.
So that is non-par for you. Now, how shortfalls or surpluses occurs in all these either of these situations. Recall that insurance companies forecast mortality costs, administrative expenses, and investment returns based on an assumptions made about life expectancy, probability of death, and economic and market conditions. So these forecasts can be wrong. Yes. And then if their forecasts are wrong, it therefore means that mortality costs can be lower or higher than expected, which inversely means that fewer people or more people may die, leading to them paying more death benefits or less. Therefore, investment returns can be higher or lower than predicted, and administrative expenses can be higher or lower than estimated. So, to the extent that actual mortality costs and expenses are lower than expected and investment returns are higher, then the insurance companies will have what? Surplus. See, this is straightforward. Now, this surplus are referred to as revenue
Mm.
to the insurance company. That means when the revenues are more than the company's needs for its administrative expenses, then will be first to be used to top up companies' policies reserve. Now, insurance regulators specify a premium level of reserves that must be maintained to meet future liabilities or pay out death benefits. Okay. So even the insurance company, then themselves, they are regulated too. And that's why when people are talking as if maybe from based on experience they have from where we are coming from, I had to keep debunking their ideas that no, things are done differently here, because even the insurance company themselves are regulated and there are regulatory requirements that they meet. And one of them is what we are seeing now. There's a level of reserve that they will have to meet, right? And after those reserve levels are met, then the surplus becomes company's profit. Okay. If there's a shortfall, that is when revenues are less than the company's needs for its administrative expenses, then the company must call up its financial resources. It cannot seek more in premium or reduce debt benefits. That's true. You understand? Because your premium and debt benefit is locked in. They don't seek, they don't ask. You get? Uh-huh. Okay. Now, non-participating policy. So this one don't participate. A non-participating or non-par policy does not share any company surplus to its shareholders. You see, surplus revenues are first used to maintain policies reserve level as required by the provincial regulators. And after that, after policy reserves are met, excess reserves are kept as profits. Profits are added to the insurance company's retained earnings, which increases the company's shareholders' equity. Alternatively, some or all of the profits can be paid out to the shareholders as taxable corporate dividend. So non-participating is just like there's nothing that you buy, you have your policy with them, you don't get anything, no dividend, nothing. So you are a non-participating whatever. Okay.
Okay.
Now, inaccurate assumptions regarding non-participating policies can result in revenue shortfall for the insurance company, and the insurance company and not the policy or the policy holder bear the burden of this loss. Yeah. Okay, not the policy of the insurance company that bears the burden of this loss. Okay. Now we have come back to participating policies again. Okay, a policy that is structured to pay the dividend is called a participating policy, also called par policy. Again, I don't know why they keep doing this. They keep like take you participating, non-par, participating. But the truth is, once you understand the concept, you understand it, okay? And that's why I don't want to rush through this. I just want us to have a grounded, you understand, understanding, and then we'll be fine, okay? Now, with participating policy, the insurance company will first use excess revenue to meet their regulatory requirement to maintain policy reserve at a specified level. And then to the extent that excess returns are not needed to maintain policy reserve, then the insurance company may return some or all of the revenue surplus to its policy holders in the form of dividend. So these dividends are not to be confused with corporate dividends. The dividend paid to a par policy owner is not the same dividend, is not, okay, the dividends are not guaranteed. Okay, let me say, paid to the investor who owns shares in a company. So now, they are telling us not to confuse this policy holders dividend to investors dividend or equity dividend. Make sense?
Yes.
Because when you buy shares in a company, that is like an investor dividend, okay? You invest in that company. This one is paid to. So dividends are not guaranteed. So the dividend they pay you, you understand? And meanwhile, the insurance company, part of this participating whole life can be freaking expensive. And the reason is because they claim to be paying dividend. And yet this dividend is not guaranteed. Okay. So the agents, as us, with the insurance brokers, we need to explain to these people, our clients, that
there's no guarantee.
yes, our prospect, that there is no guarantee that a dividend will be paid. You know, because some people, when they hear dividend like this, they thought, oh, I'll be getting
They are
it.
also saving. This insurance is also like a savings. They are keeping my
Yes,
money.
but it's not guaranteed. We need to tell them.
Bro,
Mhm.
bro, 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 8
The
o'clock.
insurance company bears a responsibility alone for revenue losses resulting from inaccurate assumptions regarding participating policies. So participating policyholders have the potential to share in revenue surplus. Therefore, the premiums are higher than non-participating. Yeah, they pay more, you understand, more premium. Of course, anything insurance company gives you, there's a price tag to it. They are not Father Christmas. Okay? Identifying the difference between participating and non-par. Most participating whole life insurance product includes the word participating, okay, in the product name. Also, participating policy contract will clearly specify how and when policy dividends will be paid. and will include a caveat that policy dividends are not guaranteed and are only paid at the discretion of the insurance company's board of directors. Okay, now this board of directors that are shareholders, like the business people's shareholders, right? I wonder how they will vote. Uh, it's like putting your faith in the hands of your competitors, because whatever is paid to you reduce what goes to shareholders. You understand? So I wish they will have a way to change this so that it will not be the same board of directors that will vote when a participating whole life will get money,
collect.
where they know that if they vote no, that money will come back to them. Or maybe there's a law there that I'm just thinking out loud. You guys, this is just me thinking out loud, guys.
This is
Okay.
above the pay grade.
Now, dividend payment options for participating whole life. Now, for someone that's own participating whole life, what are the options you have in receiving your money? There are different options you have in receiving your money. When he applies for a policy, the policy holder may choose from a variety of options with regards to how he or she wishes to receive the dividend. He can switch to another option at a later date, okay? The most common dividend options are cash. You can choose to receive in cash, premium reductions, accumulation of uh, accumulation of your dividend, paid up addition, term insurance. And then we're going to look into each of these. I think there are 5 of them one by one. Okay, they are pretty much straightforward. So pay attention. This is an exam question. Okay, they're going to ask you what are the dividend options, or following are dividend paying options, except, or which of these is the correct way of you get what I'm saying? So please, guys, pay attention to this. This is an exam testing question. They love this one. Okay. So let's look at cash. Okay. The policyholder can choose to receive their dividend in cash, and it is issued by check to the policyholder or by direct deposit. Okay. Now, who benefits, right? This form of dividends use is best for the policyholder because he receives cash in hand to use as he wishes. If he chooses, he can use the money to pay premium or to repay policy loan. It's up to the person. So the policyholder receives cash and then chooses whichever way he or she wishes to use that money. Okay, can just go on vacation, buy a new car, wherever. Anyways, so the second option is premium reduction. Okay, so the policyholder can choose to apply the dividends directly against the premium for the following year. Okay, it will reduce the amount of premium to be paid by the policyholder, and it is also called premium offset. Okay, in early years, the policy dividend is usually less than the premium. However, in later years, the policy dividend may be more than the premium, completely offsetting the annual premium. If the policy dividend exceeds the premium, the policyholder can choose to have the excess paid out or allocated to one of the other dividend options available. Okay?
Yeah.
Now, who can benefit? This form of dividend uses benefit dividend use benefits the policyholder because his premium cost is reduced. All right. So we move on to the third one, which is accumulations. You see, when you see the word accumulations, sometimes when you come across some of these terms, just reason it from the aspect of typical English meaning of the word, right?
Common
So when we
sense.
see accumulators, to accumulate means to gather together. So this is speaking to you gathering your premium together, or sorry, your dividend together for over a period of time, right? So let's read what it says here. If the policyholder choose the accumulation accumulation option, then the policy dividend will be deposited into a separate accumulation account called a side account. So when the policyholder chooses this option, then there will be a side account that will be created that this dividend will be dumped into. Okay. I'm in class. Can you go out, please?
It's because it's 8. They are hungry.
Yeah.
They're
For one
hungry here
second.
too.
Yeah. 1 second. I need to.
That's like 10 pages more.
Okay. So now this accumulated account is called a side account. So every time a dividend is paid, it goes into that account. All right. And the accumulated dividend in the side account is invested to provide additional growth. So as the insurance company is gathering the dividend together for this client, it's not just sitting down there, they are also reinvesting it where it's continued to create some additional growth for the client.
Okay.
Now, the value of the account can be withdrawn by the policyholder whenever he or she chooses, okay? The account growth in the side account is taxable to the policyholder, and the value that accumulates in the side account can increase the death benefit so long as it is not withdrawn before the person passes away. Now, in the case of this kind of side account or accumulation benefits, who actually receives the benefit? Well, the thing is neither here nor there in the sense that this form of dividend benefits the policyholder who can access the cash via withdrawal as well as benefits or as well as the beneficiary, because if the policyholder does not withdraw this money and the person passes away, then the person that benefits becomes the beneficiary. Okay, because that will increase the death benefit that the beneficiary will receive. All right.
Yes,
So
makes
we
sense.
move on to investment options. Okay. So dividends deposit to a side account earns interest, and the policyholder may choose to invest in segregated funds instead of earning interest. Okay. And then segregated funds are an an insurance industry investment with some similarities to mutual funds. Upon death, the value of the side account is paid to the beneficiary along with the death benefit and when the policy holder dies. Okay, so move on to the fourth one, which is paid up addition. Now, the policyholder can choose to use a dividend as a single premium to buy more whole life insurance. And these are known as paid up additions. Okay. So now let me just break this down for you guys. Okay. Each addition to a base policy is paid up, hence the name paid up addition. So for instance, this person have whole life policy of 500,000. Okay. Now, maybe this person's dividend may be $5,000. Okay. Now, this person may say, okay, I want to take additional 20,000 policy, and the one-time premium for this 20,000 may be 5,000, right? So this person may use this 5,000 for towards the one-time single premium payment towards this additional 20,000 policy. So that is what we call paid up addition. Okay, each paid up addition is its own policy with its own death benefit and cash surrender value. Okay, so now the death benefit of this person that used to be 500,000, now this person now have additional 20,000 that is going to grow its own cash value as well for this individual. Its coverage is as a result of the amount of dividend and the attained age of the life insured. A paid up addition, again, let's write this down. Just like I told you guys about TSV, right? Nobody will be telling you pay addition. You'll be seeing PUA, right? So through the text now, what you see is PUA. at least you know that, okay, this is referring to a paid-up addition. Okay. A paid-up addition can be surrendered without affecting the base policy or additions. So if you buy a paid-up addition, this person may say, I'm not even interested in this again. You can surrender it. Additions can be cashed in and used to pay premiums and therefore also achieve premium offset. So the same as a premium reduction method that appears in chapter 3. Now, paid-up addition increase the death benefit without the need to provide evidence of insurability. Therefore, paid-up additions can be used to increase the amount of insurance coverage, even if the life insured's health has deteriorated to the point where he or she will no longer qualify for new insurance coverage. Therefore, paid-up addition are the most popular dividend payment options. Okay. Over 90% of whole life policies sold use these options. So now when we talked about paid-up addition, who benefits from it? Well, the form of dividend use benefit both the policyholder, who can use the paid-up addition to reduce premium expenses, and the beneficiary by increasing the death benefits. All right? So that is paid-up addition options. Again, remember, recall that we have another option for dividend payment option, which is termed as term insurance options. Okay? So now, this is telling us that the policyholder can also choose to use the dividend as a single premium to pay for a 1-year term insurance policy. It doesn't have to be 1 year. It may be 2 years, maybe 5 years, depending on how much the dividend amount is, and then what the premium of the term policy is, right? The term policy has its own death benefit, which is paid if death occurs during the year. So if this person takes a term paid up policy for 1 year, if the person died during that year, then the policy will pay. Again, it means that this person will get death benefit for the term insurance and death benefit for the whole life. Make sense?
Yes, makes sense.
Like a paid up addition, the term insurance coverage is, is a result of the amount of dividend and the attained age of the life insured. Okay, medical evidence of insurability for the additional term insurance is not required. Therefore, who benefits? Well, this form of dividend use is best for the beneficiary if death occurs during the year, because the benefits will increase. It means, imagine if the same beneficiary is the same for the term insurance, is the same beneficiary for the whole life. So it means that one person collect two benefits on one person. You see, and that's why the beneficiary is the ultimate person that benefits from this kind of situation. Yeah. Okay. So we move on. We are moving on, moving on, moving on. Impact on death benefits and cash value for whole life policy. Well, for participating policy, dividend payment options have different effects on the death benefits and cash surrender value of the policy. Paid up addition may increase both the cash value, yes, and death benefit. The accumulation option may increase the death benefit if the accumulated dividend have not been withdrawn by the policyholder. So the term insurance option may temporarily increase the death benefit for the length of the 1-year term. Okay, dividends illustrations. Okay, dividends. So guys, you can read this one. Okay. Non-forfeiture benefits. So I want to discuss this concept so that we understand. All right. When we say non-forfeiture benefits, non-forfeiture benefits are advantages received by the policyholder that result from paying premiums and building a cash value. Okay. Building a cash reserve. These benefits are not forfeited, when the policy is cancelled, even if the cancellation is due to the non-payment of premiums. Okay? Sorry, let me. Okay. Okay. So, sorry about that. The longer the cash reserve builds, the greater the value available for the non-forfeiture benefit. Therefore, a policy that has been in force for 25 years will have larger sum available in non-forfeiture benefit than policy that have. Okay, so let me explain to you guys. You see, when it comes to permanent insurance, you see, you are building savings as well. Remember when I told you guys that with whole life, right? The money comes in, right? And then there's a reserve too, right? So there is a non-forfeiture benefit. So your money, part of your money is growing for you. And when the non-forfeiture benefit is to protect the policy holders, because life can happen. The person that have been paying premium for the past 20 years or 15 years, maybe may not even see value, benefit in doing that anymore. For some people, maybe the person they love so much that they were hoping would be their beneficiary have passed away, right? So now they may not see what's the need of continue to pay in this policy, whereas I don't have somebody that I'm going that will benefit from it when I'm gone. So they might choose to forfeit the policy. Now, what the non-forfeiture benefit does is that it protects the policyholder so that all their labors of these many years will not go in vain. Again, I'm explaining these things, this terminology in a layman's way, so you guys understand it from that perspective. Then you apply it, then you'll be good. Okay. So now having that in mind means that if this individual have paid this policy for 20 years, because the amount keeps growing as the year passes by, the non-forfeiture benefit at the beginning of the policy, maybe the first 5 years may not be much, but by the 10th year, it will be greater. By 15, will be, by 20, oh my God, amazing, right? So this protect the policyholder such that insurance company cannot come and wake up and say that, okay, since you have forfeited your policy, you are not getting anything, no. So this non-forfeiture benefit is here to protect the policyholder, okay? Depending on the insurance company and the policyholder may be able to take advantage of one or more of the following non-forfeiture benefits. One of the first one is cash surrender value. So the person can collect the money, right? So the cash surrender value in this policy by the 20th year, it might even be 200 or 300,000, depending on the amount. So this person can then take his cash surrender value, or he might use it towards automatic premium loan. Okay? Automatic premium loan, again, we're going to see each of these, okay? Then we have reduced paid up insurance. So that is there. Now, what is cash surrender value? A whole life policy can surrender, that is cancel his policy. A whole life policy holder can surrender, in bracket, cancel his policy at any time. He will receive the cash surrender value of the policy from the insurance company. Okay? In comparing the cancellation of the whole life policy to a term policy, the term policy holder receives nothing. All right? Now, the next point is a portion of that cash surrender value that the policyholder receives could be taxed. It depends on the ACB, adjusted cost basis. Okay, a portion of the cash surrender value that the policyholder receive will be taxable. typically a whole life insurance policy will indicate what the guaranteed cash surrender value will be at the end of each policy year. The illustration may be also shown on a non-guaranteed cash surrender value amount that may result from the policy's dividend if it's participating policy with paid up addition options. So why take the cash surrender value? Well, the reason why people may opt to take their cash surrender value is need for insurance coverage has changed. You see, like I said earlier, perhaps this person may choose to maybe to take maybe the person they name as their beneficiaries no more, and they don't have any other person. So they may say, well, to what use is this policy for me anyway? So they may want to just take whatever is in that policy in cash surrender value and enjoy their life and move on, right? Or the ability to pay for insurance has changed, or maybe they may not have the money or the wherewithal to continue paying the policy, right? So now sometimes when insurance company policy is surrendered, there might be surrender charges involved. What are these surrender charges? Surrender charges are usually levied against a policy cash value to discourage the policyholder from cashing in the policy before the insurance company can recover the expenses in underwriting and administrative costs which agents commission incurred for issuing that policy, right? So now that is why there will be surrender charges. Now, these surrender charges they are not taking client's money. Insurance company is not taking this money from the client, but they put that there to discourage the client from canceling this policy. Okay. For example, if a policy is set up, to set up that policy, we get paid. And sometimes people pay that, how can you earn so much money and the client is paying this little amount every month? Because these are expenses that insurance company is taking in advance, right? And they are hoping to recover those expenses as the client continues to pay their money. Now, when the client comes to cancel this policy, even before they recover their money, that's what we call surrender charge, right? So they put that there to discourage people from canceling that policy until they are sure that they've recovered their expenses, okay? Now, a fee is charged by the insurance company to surrender the policy. It is deducted from the cash surrender value before it is paid out. So now when the surrender charge is charged, the insurance company doesn't charge surrender fee and ask clients to call policyholder to bring it from their pocket. No, they always charge it against the CSV. Okay, so such that if the CSV is $6,000 and the surrender charge maybe is 2,000, then the person will get 4,000. Okay. But however, if this person keeps this policy for another year, then the surrender charge will become zero, and then the person get the entire 6,000. Okay.
Okay.
For whole life insurance policies, the surrender charges are not typically specified in the insurance contract. Rather, the illustration of the policy's guaranteed CSV will show zero for the first 3 years to 10 years before beginning to increase. Okay, gradually. Okay, so again, for the whole life, some companies don't even show it, but one of our companies, Beneva, they show you surrender and then they show you past value in the illustrations. All right, so we move on to policy loan. Okay, now up to 90% of the cash surrender value is available to the policyholder as a policy. People ask me all the time, okay, Joy, this money I have in my cash surrender value, Can I access it? Can I take it? I always tell them, yes, it's available to you up to 90%. Okay. The loan does not have a specified repayment schedule. Okay. Interest is charged on the loan and accumulates if the loan and interest are not prepaid. Okay. Now, the amount of the loan and its unpaid interest are deducted when the policy owner surrender the policy. Okay. The reduction is made from cash surrender value. If the life insured dies, then the reduction is made from the death benefits. Okay. But why will you want to take a policy loan, you may ask? Well, other sources of borrowing are unavailable. Sometimes people don't have any other means, so they resort to taking policy loan from their life insurance policy. Or even though other sources are available, you just have this debt, so why not borrow against it, right? Then when you have a large sum of cash surrender value, so why will you keep it? You might as well use it or borrow against it. The loan does not appear in credit reports, okay? So that is a good one, because if you go to a typical bank to borrow money, then is on your credit report. And the way Canada is structured is that any financial obligations and liability you have, it comes up on your credit report, and that reduces your chance because of your debt service ratio, right? Anytime I want to access money again, they look at, okay, how much debt are you carrying, and then how much, those kind of things. But to have this and knowing that it does not show on your credit report, that's fantastic. And then we have a typical example here. As always, I'll recommend you guys to go read the example, because it's going to drill down the understanding further. Okay, so now we move on to the next one, which is automatic premium loan. Again, remember, we are still discussing the dividend uh, payment options for whole life insurance. Okay. Oh, sorry. Essentially, the premium be paid to. No, sorry. Is this surrender? What am I?
We're on policy loan.
Policy loan.
Yeah.
Yeah, but I want to. Okay, I'll remember. Let's continue. Okay. So we'll go on to automatic premium loan. Okay. It is essential for premiums to be paid to keep a policy in force unless the policy is paid off. Okay, yes, we are looking at um surrender
We left
non-forfeit,
surrender charges.
yeah,
Oh,
non-forfeiture something, whereby as a policy holder, you don't lose your cash value because you surrender your policy. Okay.
okay, non-forfeit
These are the
benefit.
options you have. Now you have automatic premium loan. It is essential for premium to be paid to keep a policy in force unless the policy is paid up. So the APL, the automatic premium loan, is a loan that uses the cash surrender value of the policy to make individual premium payment. If the
Okay.
policyholder fails to make a scheduled premium payment, interest is charged against uh, each loan. Okay, the automatic premium loan occurs automatically. Okay, so let me explain this to you. Okay, these are the non-forfeiture benefits. Yeah, this is what I was trying to remember. Non-forfeiture benefits. Okay.
Okay.
So one of the advantage of the non-forfeiture benefits of whole life policy is automatic premium loan. How does this work? When you have whole life or any of all these permanent policies that have cash value components, let's say you travel to Africa or Barbados and you're there for months, and you didn't come back on time to make your premium payment, you're not going to lose your coverage. Unlike term insurance, with term insurance, once you miss payment for 1 month, they write you notice After 1 month, your policy is automatically cancelled. But this one is not the case. There's what they call automatic premium loan. If your premium doesn't come, they go into your cash surrender value to start funding your premium from there. Okay. For me, which I believe is very great, because that protects the permanent policy from collapsing or from expiring. Okay. The automatic premium loan is a loan that uses the cash surrender value of the policy to make individual premium payments if the policyholder fails to make a scheduled premium payment. Interest is charged against each loan. The automatic premium loan occurs automatically when the premium goes unpaid, or if the policyholder gives permission for the loan to be used. Okay? For the loan or loans. Okay. Now, a premium loan can be taken from the cash surrender value once or many times, and the policy will state a limit on what can be taken in loans. Okay? When the policy loan limit is reached, usually between 90% and 100% of the CSV, plus a 30-day grace period, then the policy terminates, and the residual cash surrender value, if any, will be paid to the policyholder. Okay? Like a usual policy loan, the outstanding balance and interest of the automatic policy loan will be deducted from the cash surrender value plus a 30-day grace period, and then the policy terminates. Okay. Like a usual policy loan, the outstanding balance and interest of any APL will be deducted from the death benefit. What is the benefits of APL? Well, it prevents policy from lapsing due to forgetfulness. You know, some people forget, right? Maybe they are somewhere chilling and they don't remember. It eases financial pressure on policyholders whose financial situation prevents usual premium payment. For example, you can see that for some people, maybe their job is a contract position, and then when they are working, they earn a lot of money, and then in between jobs there's no money coming in. At that point, they have to be planning and managing whatever savings they have. So if they have this kind of policy, at least they have that option that they can pause the withdrawal from their account and instruct the insurance company to fund their premium from their cash value. Okay. All right. So move on to reduce paid up addition. Again, that is non-forfeiture, one of the non-forfeiture benefits of whole life policy. Ooh, we're making progress. All right. Now, this is an option. Don't worry, you guys will thank me later. This is an option for a policyholder who wants insurance coverage without continuing to pay premium. It provides the policyholder with paid up insurance. So again, this is a situation whereby somebody have a cash value and they don't want to keep paying them money every month. They can just take that cash value. Maybe the cash value may be 200,000 or 100,000. They just use it and paid up whatever premiums they will have to pay for the rest of the contract, right? And then they have their peace of mind. Okay. The reduced paid up insurance is acquired when the cash surrender value of the policy is converted into a single premium. And that premium pays for a new whole life policy with a smaller face amount than original. The amount of coverage is determined. Okay, 1 second.
Proud of you.
Thank you very much. I just want to take a step back, okay? A reduced paid up insurance, okay, this is an option for a policyholder who wants insurance coverage without continuing to pay premium. It provides the policyholder with a paid up insurance, okay? The reduced paid up insurance is acquired when the cash surrender value of a policy is converted into a single premium, and that premium pays for a new whole life policy with a smaller face amount than the original policy. Okay, so again, I take a step back because I wanted to explain this sentence right here. Okay, so now this cash surrender value is not paying up the whole entire policy as existed before. By that, I mean that, for example, if this policyholder have 500,000 face amount before, right? Now, the cash surrender value might able to only pay up for 300,000. So that premium pays for a new whole life policy with a smaller face amount than the original. In this case, this cash surrender value is paying up for like 300,000 as opposed to the 500K before. So that's what I wanted to emphasize to bring to our understanding. Okay, the amount of coverage is determined by the amount of the cash surrender value available and the attained age of the life insured. There is no need for any medical evidence of insurability. A reduced paid up insurance results in a smaller death benefit as well as the permanent coverage, for example. So this is the continuation of the example of Ella that we have read before. So if you have not read that, I will encourage you to go read that. Okay? Mhm. Extended insurance. Okay, and this is another option for a policyholder who wants insurance coverage without continuing to pay premium. Okay, it also provides paid up insurance, but converts the whole life policy into a term policy. Okay, now the extended term insurance is acquired in the same way as reduced paid up insurance. So the cash surrender value of the policy forms a single premium. However, with this option, the premium pays for a new term policy with the same face amount as the original whole life policy. The duration of the new policy's term is determined by the amount of cash surrender value available and the attained age of the life insured. Okay? A large cash surrender value and a young attained age might pay for a term policy that expires in many years. A large cash value and an older attained age might pay for a term policy that expires in years, but fewer years than when the policyholder is younger. That is very typical because the older one is due to the fact that term insurance have a limited coverage period. Yeah. So there is no need for medical evidence of insurability, and in some extended term insurance results in the same death benefit as well as temporary insurance coverage. For example, as continued from Ella's case. So please read this home, okay? Now we move on to limited payment whole life, okay? Limited payment life is a whole life insurance policy that provides lifelong insurance coverage while limiting the premium payment to a set number of years or to a specific age. Once premiums are no longer required, the policy is said to endow. I love that word, endow. The premium for a limited pay policy will be higher, okay? Will be higher than for a whole life policy where premiums are payable to life. This is because the life insurance coverage continues after the premium payment stops. I gave us this example earlier, and I also told us that I use this strategy, limited payment options, a lot. You see, because with permanent insurance, you don't want to burden people with continuous payment of these premiums. No, you want to make it limited, you could limit the payment to like 20 years, you could limit the payment to like 30 years, okay? Depending on their age. For me, when people are younger, then I could make them pay for 30 years. For example, when I mean younger, if they are like 35 years, 30 years, yes, limited payment for 30 years, so that before they get to retirement age of 65, their payment is done. Okay. But when people are 40 plus, to start making them pay for 30 years, meaning they'll be paying insurance premium into their 70s, right? So you want to start looking into these options when you sit down with your clients, and also give them options to show them, okay, for paying for 20 years, you pay more, but your policy will endow. I mean, you will stop paying sooner, right? Okay. So let our clients know they have that options. So the insurance company determines the limited payment premium based on the sum of premiums the policyholder will pay for his entire life. All right. And in bracket, we see based on his assumed life expectancy. And the company uses this sum to determine the premium it would have to collect over the limited payment period to obtain the same financial result. All right. Why choose limited payment over lifetime pay? Well, the policyholder knows when his premium commitment ends, and the policyholder can coordinate premium payments with income. Premiums can be timed to end our retirement. You see, guys, I say that, right? Uh-huh. Now, the policyholder avoids longer longevity risk, in which he could be paying premium for a life insured who lives longer than anticipated. All right. All right, we move on to premium offset policies. Hmm. All right, so premium offset policies, right? The premium offset refers to the use of policy dividend to reduce the amount of premium paid, okay, by the policy holders. Okay, so premium offset can be achieved by premium reduction that uses policies dividend to pay the premium directly, or paid up addition in which annual dividends are used as a single premium to purchase additional coverage. All right. So yeah, what is the benefit of premium offset? So who benefit? What is the benefit? Well, the policyholder pays less. Therefore, they may be more easily persuaded to buy a par policy. Okay. So illustrations and disclosures. See, agents need to exercise caution when marketing policies with these provisions to prospect clients, because policies dividends are not guaranteed. Okay. So look at all these things that we need to be cautious of. All right. Now, advantages and disadvantages of whole life. Again, these are in a table here. Okay, read through it, look at the disadvantages, and then look at the setback of whole life. All right. I think there's a ton of information here that we're not going to go through it one by. Okay. Awesome. So this is whole life, and then all these are. Mhm. Mhm. Again, so we look at the advantages, disadvantage, then the cash value, the payment, all the investments of whole life and participating whole life and all that, the benefits. Okay. Now here we see using whole life insurance. Okay. Now a whole life policy is an appropriate choice when this is speaking to when do we use whole life okay, when the need for insurance is permanent, okay, and also the policyholder enters a policy for purpose that arises at the end of life for the life insured. And secondly, the policyholder will be able to afford the premium for the selected premium payment schedule. It may be once, it may be limited, it may be lifetime. Okay, but we need to uh, pay close attention to this point because this speaks to affordability. Okay, the policy holder is willing to pay the premium over the entire payment period, or the policy holder wants insurance coverage to increase, for instance, to keep pace with inflation, and is prepared to select a par policy that will accomplish that objective. And also, the policyholder does not want an investment aspect to his policy. Okay. How is taxes calculated up on debt? Well, one purpose for the death benefit from a whole life policy and other form of permanent insurance is to pay income taxes that becomes due on death. So the use of insurance to cover tax liabilities at death allows for the value of the estate to remain intact and not decrease by the taxes due. Okay, such taxes applies to investment assets, non-principal residences such as cottages, and to business shares of private companies, for example. We'll read this example here, and then we also continuation of this example here. Okay, and then future insurability, this speaks to the fact that when in future, when the individual with permanent insurance wants to increase their policies, they do not have to provide evidence of insurability. See, whole life insurance provides lifetime guaranteed insurance coverage at a fixed price as long as premiums are paid. If acquired when an individual is young or before health concerns arises, it can be more affordable than when acquired later in life or once health issues surfaces. As health deteriorates, one runs the risk of being uninsurable for new insurance coverage. Okay. All right. So we move on to increasing coverage. Eh, yeah, make progress. Yeah. All right. So participating policies provide easy ways for the amount of life insurance coverage to increase over time without the need to provide medical evidence of insurability. So go ahead and read this example. Okay. All right. So that brings us to 10 to 100. So we've successfully completed whole life insurance. So I think the last part of this chapter is this 10 to 100. So let's quickly fly through 10 to 100. It's not as complicated as whole life, okay? 10 to 100 combines elements of term insurance and permanent insurance, okay? When it comes to the duration, it's still 100 provides lifelong coverage. Some policies matures at age 100 and pay the death benefit when the life insured reaches age 100 or dies, whichever comes first. Some policies only pay the death benefit when the life insured dies, but the premium ceases at age 100. Okay? Premium ceases at age 100, even in the death benefit has not yet been paid out. Okay? Premium cost is lower than whole life insurance and higher than term for the equivalent amount of coverage. T100 policies do not accumulate cash value and do not provide non-for future benefits. Excuse me. Automatic premium loans are not available to cover missed payments. Thus, a missed premium that is not paid by the policyholder within 30 days grace period can lead to a lapse or cancellation of the policy. Some policy gives the policyholder the opportunity to reactivate their lapse payment. Thus, a missed premium, their last policy within a period of set time. Okay, and the missed premium must be paid within 30 days grace period. Okay, must be paid. Okay, that's good. Let's go down. Okay, now level cost of insurance. Most T100 policies charge level premium for the duration of the policy, which is referred to as level cost of insurance. Okay, level cost of insurance does not provide for the accumulation of any cash surrender value or any other non-forfeiture benefits. Premiums are based on the attained age of the life insured at policy issue date. Okay. The younger the life insured is at the time of the issue, the lower the premium for life. Okay. Limited payment T100. Well, like limited payment, whole life premium payment for T100 may be limited to a number of years to a set age. At the end of that period, the policy is then paid up because premiums are paid over a shorter period of time. The premiums for a limited pay T100 are higher than that of a straight T100 policies. T100 policies that are limited payments have a CSV. Its value can be received by the policyholder if he has no need for the policy. And the CSV can also provide automatic premium loans like whole life policy. Okay? All right. So upon death, upon let me see. Okay. Death benefits. Well, the death benefit is equal to face amount of the policy and is fixed for the contract duration. Okay. Upon age 100, what happens? Well, what happens is that when the life insured reaches age 100, depending on the insurance company and the detail of the contract, some policies specify that the death benefit will be paid to the beneficiary when the life insured turns 100. Other policies may specify that the death benefit payment that the payment of the premium ceases at age 100, but coverage continues until death. Okay. Availability from insurers, basic T100 policies. Those without a CSV and with premiums payable until age 100 are readily available from major insurance companies and other financial institutions. And for limited T100 payment policies are no longer common in Canada, but they are available in the US market. Okay. So using T100 insurance may be appropriate when the following conditions apply. Okay. Sorry, guys. The policyholder requires a fixed amount of insurance to cover a need that is not expected to increase prior to death, regardless of when the death might occur. The policyholder is certain that he will never want to surrender the policy. The policyholder has no need of the investment opportunities provided by universal life insurance. So see, as we can see in this example here. And that brings us to the end of chapter 3. So we're not going to be doing Q&A in this class. So that will be your takeaway. Throughout the week, go through this class and do your Q&A. With this class, I believe you will just be fine with the Q&A. Thank you very much for your time today, and I will see you in the next